At your ages, you can still be selective. I need a tall guy.
With the business. Chewe. Okay.
Bene. 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 Alo, pong.
Okay, so good morning, ladies and gentlemen. I can see you're very ready, and we are sorry that we have been disturbed by the technology things. Nonetheless, we are here, and we are here to do the final touches. I want you to bring all your souls and spirits in this room, and those of you who are online, put all other gadgets aside, put everything that you're going to do today, forget about everything else around you and focus on today's session, because I am very sure that even if you have not been ready, you must be ready today. If there is anything that you have not mastered before, you must master it today, and I'll make sure that I bring it closer to the exam. In other words, whatever I'm going to say is almost what you need to do in the exam if it is not what you're going to do in the exam. In other words, whatever you do it in the exam and you will not regret. Whatever you do here, whatever I tell you to do it. If you do it and you don't pass, please come back, I'll pay you. But we must confirm that you did it. Because sometimes you students get out of the exam and you say, I actually did everything. And then when the exam comes, we find that you did not do everything. So to those of you who do not know me, my name is Council Julius Nandeva, as they usually call me, and I am the tutor of taxation and advanced taxation here at Capital College. Outside Capital College, I work at the Uganda Revenue Authority, and I manage the financial and insurance sector under the Large Taxpayers Office. I have been working with URA for the last 15 years. Yes, I am a professional accountant, and I'm also a lawyer and a tax administrator and aspiring gynecologist. Why are you laughing? You did not laugh about the other qualifications. Why are you laughing about the gynecologist? That is my retirement course, because I have studied everything else other than. You see, as you retire, you must do things that you love doing. So that is one of the things that I'm going to do as I retire. I have talked about it and people think I am joking. So ladies and gentlemen, without much ado, I am sure that we have a good number. I see over 100 online. I see the class is also full here. So I have the audacity and I think the authority to start now. If you allow me, we are going to start. Our menu today is full, and therefore I expect that you have eaten some good breakfast, but I also give you some few minutes to pick some breakfast. I have carried lunch myself. You saw me with a lunch bag and some of you laughed, because for me, AO is AO. We are in AO. We are only left with how many days? 2 days, almost 2 days. So this is our zone, and there's not going to be any relaxation, because we are going to cover about 7 areas, which I am sure you have a 98% chance of finding in your exam. So the fact that they are in the exams, it means you must pay attention today. If it means pushing even up to 6, we will push up to 6, but we must cover them. What are the areas that I think are almost compulsory for, because this is a combination of both paper 11 and paper 17. But remember, you apply the same tax laws. You are going to do almost the same numbers. What changes is the complexity of these numbers. Whereas there are certain complex items that you add in paper 17, but the principles remain the same, because we are using the same laws. So number one that you're going to make sure you appreciate before you start dozing or before you get tired is income tax from business. Income tax from business. All of us are going to be given numbers of persons who are in business, and they'll be asking you to calculate their income tax. And these persons are likely to be any of the three. Please prepare for any of the three. The other time I warned students, I said, prepare for any of the three. Some guys in paper 11 did not understand what I meant. They thought every number one is going to be business income for a company, business income for a company. Boom, number one, business income for a partnership. And some guys had closed their mind on partnership. So I want to warn you again. When we talk about number one, it is either going to be business income for a company, it is going to be business income for an individual, or it is going to be business income for a partnership. And you must know how to do those three numbers because they could turn out to be your number one. The number two area that we must all appreciate is VAT. Is VAT. Why? By the way, before we even get into the numbers, these are the taxes that we collect. And when we are setting the questions, we set the questions around the taxes that we collect. So which one is the main tax? Income tax. That's why it surfaces as number one. Tax number two is VAT, value added tax. Now within VAT, there are three things you must remember. Because within VAT, there is the normal VAT that we know, but there is VAT on imported services and VAT withheld or withholding VAT. So when we are looking at VAT, make sure you understand these three aspects in VAT. VAT, the value added tax that we know. Number two, VAT on imported services. And number three, withholding VAT, or what we call VAT withheld. That is VAT. So we've talked about income tax, we've talked about VAT. The next tax that we collect is called withholding tax. The next tax that we collect is called pay as you earn. Pay as you earn is the number of employment income. The next tax that we collect is called rental tax. So you must remember also the principles of rental tax. And then when you're a small business, we collect what we call presumptive tax. And then there is a tax called local excise duty. That is when we are talking about domestic taxes. I am going to repeat them. And note that the exam usually is testing on whether you know how to calculate these taxes. Number one, which is the main tax, is called income tax. That's why we must cover a number on income tax. I must guide you on how to calculate income tax. And I told you, income tax can be collected from either company, an individual, or a partnership. Those are the main areas of the exam. Number two, I talked about VAT. Number three, I talked about withholding tax. I talked about pay as you earn. I talked about rental tax. I talked about local excise duty. And then for small businesses, we have what we call presumptive tax. Those are about 7 taxes. How many are those? About 7 for domestic taxes. Then for customs, we are going to actually have a number on customs. That's when you have to actually now know that the exam is balanced. So a person who actually sets an exam and wants balance between taxes that we collect on international trade and taxes that we collect domestically is going to set an exam that has those 8 areas, or at least 5, 6 of them. Income tax. Now these are the areas that you must know before you enter the exam. These are the areas that you must know before we enter the exam. Number one, computation of income tax from business. Number two, VAT, computation of VAT. Number three, computation of pay as you earn. Computation of pay as you earn. Number four, customs, computation of customs taxes. And then after knowing those 4, which I would call compulsory areas, then you can add on the other areas such as capital gains, and such as rental tax. And usually rental tax is going to be part of your income tax computation because of its principles. So we are going to cover, we have talked about those 7 areas, actually 8 areas, and each of them is going to be talked about today. So you can see how much we have on plate. And therefore, when I put in some little speed, accept, and then if you have any questions, we will always interact at any time. Guys online, please confirm that you can hear me. Confirm that you can see my screen. I am going to open up. We are going to start with the number 1, and that is business income from a company, because most of the exams have actually examined a company. But afterwards, we shall also see how the other questions are also set. Now, I am opening 2 questions, one on paper 17 and another one on paper 11, so that you see the similarities. I can now pull off my video since those who did not know me have seen me. But I want you to see the similarities between paper 17 and paper 11. The similarities, if this is number 1, I am opening up number 1 of last sitting, August 2025. But I want you to see the question and setup of the question, and then we relate it with the question in paper 11, and then you realize that you're doing almost the same questions. When it comes to this paper 17, number 1 of last sitting, the requirement was advise the management of school on the chargeable income and tax payable for the year ended 30th June 2024. They are asking for 2 things: chargeable income and tax payable. That is what you're going to be dealing with if you're dealing with a number on income tax, whether it is an individual, whether it is a partnership, whether it is a company. You're going to be looking for chargeable income, and from the chargeable income, then we look for the tax payable. You cannot get the tax payable unless you have chargeable income. Now, the others are details, because even if they did not ask part B, for example, part B is saying the capital allowance is due to the company for the year ended 30th June 2024. Even if they did not ask part B, you will end up doing part B in part A, because you cannot get chargeable income unless you have computed capital allowances. It is part of the journey. Part C is saying the rental tax due for the year ended 30th June 2024. They did not even need to ask you about that, because if I place any rental income in that POL, automatically you must calculate rental tax. Whether I have asked you to calculate it or not, the moment I place it in number 1, the moment I place it in a number of income tax, you must be compelled to calculate rental tax. So part B and part C are idle in terms of requests from the examiner. I would have even asked part 1, and you were compelled to do part B and part C. But I want you to see the structure of the question. And once you see the structure of the question and know what you're looking for, it is easy for me to run through the question. Number 1, whether it is a partnership, whether it is an individual, whether it is a company, as long as they are looking for income tax from business, they are going to start with 2 things. Number 1 is that they are going to give you a POL, what you call a statement of profit or loss. A statement of profit or loss. Number 2 is that they are going to give you notes or additional information that break that statement of POL, because the statement of POL is a summary. When you look at this, they are just giving you a summary of incomes and expenses for you to be able to get the profit. Because on the best level, we know that when you get incomes minus expenses, you get a profit or loss. But on the face of the statement of profit or loss, you cannot know what exactly are the transactions. So what they do in every number is that they give you the particulars of the things they are talking about, and then they give you a column of the notes. The notes, they are saying if you want to know the details, go down and see the details that, for example, are in revenue. But at the exam level, when they give you a note, the examiner is saying, I am breaking it for you because there is an item you must take to the tax computation. I am not only breaking it because if there is nothing to take to the tax computation, I have no business breaking it for you. So every time you see a note, they are giving you details for you to be able to pick items that will go to the tax computation. So take note of the particulars, take note of the notes, and then the amounts. These amounts are summarized. If you want to know the breakdown of those amounts, then you read the notes that are attached to each of those items. Does it mean that an item that has no note on the POL has no effect? No, you also must be careful because there could be some items where they have not put a note, but they have an impact on the tax computation. Now, once you understand this, there is one item that is going to be clear on the face of the POL that starts your tax computation, because we start the tax computation with the profit or loss before tax. And everyone must be able to get to that mark without hassling. Now, the profits before, you see these profits, we have a gross profit, we don't need that. We have the operating profit, we don't need that. We have the profit before tax, that is what we need. We have the profit after tax, we don't need that. We need the profit before tax. Now, whatever name they call it, whether they call it net profit, whether they call it profit before tax, but you're looking for a profit which has not yet suffered any. So any profit that is above the word tax, if it is there, is what you're looking for. If they stopped here, for example, called this profit before tax and called it net profit, but you know they have not charged tax on it, that is the tax that is the profit you'll be looking for. That profit can also be a loss. So when it is a loss, you take it as a loss. When it is a profit, you take it as a profit. Now, after taking that profit, in your number one, you're asking yourself, this is the fundamental question you must ask. Because to get to this profit before tax, what happened? I got incomes minus expenses. Not so. But as a tax person and as the exam is going to be, this profit before tax is not the actual profit we should tax. And the examiner wants you to turn it into a taxable profit. And that taxable profit is what we call chargeable income. Now, if you give me this profit before tax and you want to turn it into a taxable profit, I am reminded that by the time you got this profit before tax, you got incomes minus expenses. So what do I need to do? I will stand here on profit before tax. Whatever else is down is useless for me. Whatever else is below is useless for me. In that statement of profit or loss, the moment you get to the profit before tax, anything below the profit before tax is useless. Because then I have to look upwards. When I look upwards, what do I start with? I look at these expenses, not so. What question am I asking? Are all these expenses allowable, or we have some non-allowable expenses? And my target is that I will study these expenses. By the way, the expenses are embedded in cost of sales, embedded in these other costs. And those are expenses. Now, these expenses have a mixture of two things as a taxman or taxwoman that you're looking for. Some of these expenses are allowable and others are not allowable. What are you looking for? I am not bothered about allowables. I am only bothered about non-allowables. And I am saying, whereas you deducted them from the income, they shouldn't have been deducted. I have this profit before tax simply because you deducted some expenses. Are those all expenses deductible? If the answer is no, it means I'm looking for the non-allowable deductions. And the moment I discover them, I want to add them back to this profit so that it becomes bigger. Because I'm saying by the time you got this profit, you had knocked off some expenses. Where the expenses, they are actually in the mixture of cost of sales, they are in the mixture of distribution and selling costs, they are in administrative expenses, they are in other expenses, they are in finance costs. But the fact that you gave me a note, it means there are expenses that are seated there, which should have not been deducted if I am seated now as a taxman. You could have deducted them because you are an accountant. But now I am putting on the hat of a taxman, and whatever the tax law does not allow as an allowable deduction, I must add it back to the profit, because I want my profit to go back to where it was before you removed those expenses. Number two is that incomes have an impact of increasing the profit. And incomes are in two lines. There is income in revenue and also income in other operating expenses. Now, rather in other operating income, or what we call other incomes. What am I looking for in incomes? Because incomes had increased the profit. But these incomes, there could also be incomes that were not supposed to be included in the incomes. And I want to pull them out. How do I pull them out when I am doing the tax computation? I go to the tax computation and subtract them. Because the impact they had on my profit that I have started with is that they had increased the profit. I want to repeat this because this is the best principle. When you pick any expense from the POL and you want to adjust it on your profit or loss before tax, you'll be adding it back. And the reasoning is it is non-allowable. It shouldn't have been removed from the profit. If you pick any income from the POL, you must go to the tax computation and subtract it because it had increased the profit. So the incomes must be subtracted. The expenses must be added back if they are coming from the POL. And all you're doing is make sure that you turn this profit before tax into what we call chargeable income or what we call taxable profit. This is called the accounting profit. But I want to turn it now into taxable profit or chargeable income. And what do? I start from what the accountant did. What did he do? He got all the incomes according to accounting rules. He removed all the expenses that he thought are allowed according to the accounting rules, and he got his profit before tax. For me, I am coming with the tax rules, and I am saying some of the incomes that I see were not supposed to be included in your incomes. So I want to remove them. It means in the tax computation, I must remove them. Unless allowables heading. When it comes to expenses, I am saying these expenses should not have been deducted from the POL, and therefore I take them to my tax computation and add them back. Now, I have told you whether you're in paper 11 or paper 17, they are going to give you a POL, which POL will also have notes. When you go to the notes, they will be breaking down for you the items in the POL. Ladies and gentlemen, if, for example, they said revenue, it does not mean that they have a problem with all the figures. It does not mean that they have a problem with all their figures they have a problem with. And those are the ones that you're looking for. If I'm looking at revenue and other incomes, what am I looking for? I am looking for incomes that should not be included in gross incomes. The ones that I have no problem with, I don't touch them. So I am only looking for outliers where me and the accountant don't agree. The accountant says, this is income. Tax law says, this should not be taxable income. And I want to remove it. When it comes to expenses, it does not mean that when they break for you all the expenses, they have a problem. No. They are breaking them for you to be able to pick the expenses that are non-allowable. The ones that are allowable, you have no problem with them and don't touch them. If I say this is cost of sales, I am only asking you pick items that are non-allowable. if I say this is distribution cost, I am not saying the figure of distribution cost has a problem. But I'm saying pick only the costs that you think are non-allowable. Because the accountant says, for me, I believe all these are my expenses. And they add up to 18 million. You, as you come, you say, when I look at all these expenses, there is an expense that I have a problem with. And that is the expense where I'm actually saying it is non-allowable and I want to take it to tax computation and add it back. The others that are allowable, don't touch them. They have no place in the tax computation. I hope we are now on the same page. Now, over and above the POL, because we said the POL only shows two things: incomes and expenses. But the business also has what we call the capital expenditure that does not go through the POL. The capital expenditure goes to the balance sheet, not so. The statement of financial position. Now, there are going to be notes that do not speak to the POL, but speak to the balance sheet. They have not given an extract of the balance sheet, but they are going to give you notes that speak to the balance sheet. And those notes, you will see them, whether in paper 11 or paper 17, you will see these notes that look like this. I want you to see note number 8. You are going to find it whether you want it or not. You're going to find a note on the wear and tear schedule. Because that note is saying you are now going to calculate capital allowances that are applicable to depreciable assets. And you must draw the wear and. So one of the skills before you get into the exam, you must know how to draw the wear and tear, because it is compulsory that you will draw it once you see those classes. Number 2, if you see buildings, and which is likely to be the case, you're not likely to do a number where you have not been tested on a building. You're going to be required to calculate what you call industrial building deduction. So when you see these two items, this one, which is on the wear and tear, they are looking for wear and tear allowance, or what we call depreciation allowance. And when you look at the building, they are looking for IBD. And those two are called capital deductions. So what does that mean? It then means that your number 1 has 3 things. It has the POL, it has the wear and tear, and it also has IBD. If you master those 3 things, you'll be done with your number 1. What are you looking for in the POL? You're looking for 2 things: non-allowable deductions and non-taxable income, or income that should not be included in gross income. What are you looking for in the wear and tear? Depreciation allowance or wear and tear allowance. What are you looking for in the buildings? IBD, industrial building deduction. Now, that is paper 17. I want you to actually now relate it with paper 11. Same number 1. Same number 1, they gave you the POL. It has notes and it has amounts. They've gone ahead to give you the notes. They have gone ahead to give you information about the wear and. They've gone ahead to give you information about a building. For example, you see this building, you see these buildings in note number 13. And the question is saying, determine taxable income and tax payable. Taxable income is the same as chargeable income. But the baseline is determine chargeable income and tax payable. So the game we must master for number 1 is how then do I determine this chargeable income? And this is what I want you to do in the exam. This is what I wanted to do in the exam. We first master the formats. We first must master, because if you don't know the formats, it is very hard for you to start. When they give you that number 1, whether it is a partnership, whether it is for a company, whether it is for an individual, you must draw the heading. You must draw the heading. And the heading comes from the requirement, because the requirement is saying required, compute, chargeable income, and tax payable for a certain person for a year of income. If that person is called ABC Limited, my heading will be reading computation of ABC's Limited's chargeable income and tax payable for the year ended either 31st December or 30th December, rather 30th June, whatever year they have given you, but it must have a heading. After you have a heading, you're going to draw 3 columns. You're going to draw 3 columns. And column number 1 is going to be named either description or the details or particulars. You have seen what the examiner is calling them. For example, in this paper 11, he called them. Did he give them headings? No. But in paper 17, he called them. What did he call them? He called them particulars. So you can also call them particulars, but the naming will not affect you. Whether you call them particulars, whether you call it the description, whether you call it the details, it will remain the same thing. But you've drawn your column number 1, you've drawn your column number 2, and you've drawn the column number 3. Now you must know, what do I put in column number 3? Because that is the last column. These are the figures that you put in column number 3. These are the figures that you put in column number 3. Column number 2 is like putting all the details in column number 2. All the detailed figures before you get to the additions are put in column number 2. But the totals are put in column number 3. And those, which totals are those? Number 1, the profit or loss before tax goes to column number 3. Number 2, all the totals of the add backs. When you add back all the items, the total goes to column number 3. All the less allowables, the total goes column number 3. The moment you get to those 3 figures, profit or loss before tax, add back the non-allowables, you subtract the allowables, you get the total of them, and that total is going to give you the chargeable income. After chargeable income, all the other items will go to column number 3, because after chargeable income, everything else is for adjusting chargeable income. Now, assume I want to be sure that everyone now will pass an item of profit or loss before tax. Remember, we are looking for 50 marks as a starting point. We are looking for 50 marks. So you must ask yourself, how am I going to get to the 50 marks so quickly? And then I can start looking for Julius's 80 if I want to win $1 million. But before you focus on 1 million, first focus on the 50%. Because if I actually focus on the 1 million, even the 50% fails. Someone says, I want to perfect this exam because I must get his 1 million. I want to give you the 1 million, even if all of you pass, by the way, I would give you the 1 million. But my prayer is that everyone gets at least 50%. So I'm going to show you things that must help you first to get to the 50%, because there are things that are not going to change. That even if you cram them now and press them in the exam, you'll get a mark. So open your eyes and be sure that these ones, I have understood them and I'll press them where they're supposed to be pressed. So number 1 is profit or loss before tax. We saw where we are picking it from the POL. And we come and press it in the 3rd column. Please do not mind about these columns, because I've had students asking, in the exam, are we required to show the sections of the law? Please do not show any section of the law, and it is not required anywhere to earn a mark. Are we together? So do not be bothered about the sections of the law. This is only for your understanding. So we have 3 columns, and we have picked the profit or loss before tax and pressed it in column number 3. If it is a profit, bring it as a positive. If it is a loss, bring it as a negative. The next subheading, which I'm calling number 2, is add back non-allowables. Add back none? What am I speaking to? I am speaking to the POL, and I am speaking to the expenses. because we are saying all the expenses the accountant claimed, there could be those that are non-allowable, and this time I must come and add them back to the profit. Now, you're going to see some of the expenses that when you see them, even if you have forgotten, at least the biggest bet is, I would rather add them back than ignoring them. And the common one that you will see and you can't miss is the depreciation. If we see any depreciation in the POL, ladies and gentlemen, come and add it back. If you don't know why you should add it back, I will explain that after 11. But for now, add it back. Number 2 is to do with entertainment. To do with entertainment. Ladies and gentlemen, the principle in income tax is general entertainment is not part of the business expenses. General entertainment is not part of the business expenses. So if they give you just one item and call it entertainment, don't even bargain. If it has no notes, qualify it. Because general entertainment is not an allowable. But what is involved in entertainment? Giving people meals, throwing parties on them, doing team buildings for them, refreshments, recreation, that is entertainment. Now, what is the only exception about entertainment? Because when we talk about entertainment, we are speaking into Section 23 of the Income Tax Act, and it makes exceptions. It says for you to actually allow entertainment, and meaning meals, refreshments, and entertainment, you will only allow those meals or refreshments if they are provided to all staff, full-time staff, on equal term basis, or if they are provided to staff while undertaking travel in the course of performing business, or if this person's business is entertainment. Because if I'm Serena Hotel, all the costs that I incur on entertainment to provide it to my clients for them to be able to pay a price, those costs are allowable deductions because that is my business. But the other businesses, the other companies, they can only be allowed the cost on entertainment. Number 1, if it involves meals and refreshments provided to staff on equal term basis. The common thing they test there is staff parties. Staff parties are non-allowable deductions. You see them, add them back. You see them, add them back. So what are the examples that they have actually brought before? Usually staff parties, you will see them. The next thing, or the next thing that you must remember to add back if you see it, if they ever tell you that in your incomes, in your POL, you have any income called an exempt income, ask yourself, do I also have an expense related to that exempt income? Why? Because all exempt income is going to be removed in the tax computation. And therefore, any expenses that we are incurred in generating the exempt income must also be added back. Because if we are not taxing the income, we should not allow you the expenses that you incurred to generate that income. So in case they give you any exempt income, if they tell you this income is exempt, then, and they have also given you expenses related to that exempt income, you remove the income and add back the expenses. Next, that is very common, and I call this a free mark: loss on disposal of assets. Businesses dispose of assets every day, and the accountant must calculate whether they got a gain on disposal or loss on. Now I'm going to explain them together. When you go to the POL, where does the accountant press the loss on disposal? In expenses, not so, but it is a non-allowable deduction. You see it, add it back. If it is again, where do they press it in the POL? Other incomes, it is not taxable income. So you see it, what do? Subtract it. So loss on disposal added back. Gain on disposal subtract. I am going to jump that balancing charge for now. I'm going to explain this later. Donations. You will see almost in every exam there is a donation, because they know that students will actually deal with, they know that businesses live to do CSR activities. You know CSR? Corporate social responsibility activities. We thank you for doing the corporate social responsibilities, but they are not business expenses. And therefore, every time you do a donation, every time you do a sponsorship, every time you do a cancer run, every time you're sponsoring your MP, every time you're sponsoring your school near your home, you are doing a good job, but those are not allowable business expense. So what the law did is then pick some of the donations that can be allowed and defined them and said, these are the only donations that can be allowed, and put two conditions. If you see a donation, test these two conditions. If they fail, please add them back. Number one, it is about the organizations that you gave the donation, and there are only 5 that can qualify. If a donation goes to any other organization other than the 5 that I'm going to tell you, please automatically don't ask your question, any other question, add the donation back. If it has been given to any of those organizations I'm going to talk about, the next question is, was it an appropriate amount? And the appropriate amount is that it should never exceed 5% of the chargeable income. So you test two things. Is the organization right? Is the amount right? So which are these organizations? Number one, amateur sporting association. If they tell you the donation went to an amateur sporting association, you first tick number one. You say, question number one, answered. Organization number two, charitable organization. If this is a charitable organization, you first tick. Number three, religious institution. Number four, educational institution. Number five, scientific research institution. But the catch point is that those institutions must be not for profit. Must not be for profit. So what does the examiner do? He picks the school and throws it at you. And for you crown the education institution and you fall in the trap. Those, even if they're education institutions, they must not be for profit. But the catch point also is that those organizations must have a certificate of exemption. It doesn't matter whether you're an NGO, it doesn't matter whether you're a children's home, a homeless children's home, whether you are a church, you must have a certificate of exemption. If you don't have a certificate of exemption, or if the examiner has not confirmed that this organization has been confirmed as an exempt organization, do not just follow the name. So the catch point is, it must have a certificate of exemption, or the examiner has told you that it qualifies as an exempt organization. Those 5. Once you pass the test of the organization and you're sure that they have a certificate of exemption, the next thing is, how much did you give out? How much did you give out? That must never exceed 5%. And I'm going to show you later how you compute the 5%. But any other donation, irrespective of how important it was, irrespective of whether it was for COVID-19, irrespective of whether it was for anything, is a non-allowable deduction and must be added. The reason why I'm emphasizing it is that it almost comes in every exam. Next is provision for doubtful debts. Again, this is very common. Now we have two things. We have a provision for doubtful debts, and we also have bad debts. Sometimes they call them bad debts written off. It is the same nomenclature. Bad debts and bad debts written off mean the same thing. Ladies and gentlemen, in the exam situation, bad debts or bad debts written off are allowable deductions. Don't touch them. Whether they have added literature to it or not, please don't touch them. Because historically, the examiner has allowed them even without attaching meaning to it. Of course, in practice, we ask you whether you took the reasonable steps, and you must prove that before we allow it. But in the exam situation, bad debts or bad debts written off, please Okay, sorry for the ones online were actually saying they were not seeing the Excel sheet. I'm sorry for that. Please keep on putting in those comments. The admin is actually looking at them and will be able to come back. And I will also pick these comments as we conclude this area. So, I talked about provisions for bad or doubtful debts and then bad debts. If both of them were in the POL, the only item I would take to the tax computation is provision for doubtful debts. I wouldn't touch the bad debts. So do not touch the bad debts, but any provision for doubtful debts is going to be added back. Now, if they give you a question of financial institutions, because someone was asking me, what if it is a financial institution? If they give you a question on financial institutions, for financial institutions, they have certain provisions that are allowable. And the financial institution will give you both specific and general provisions. For example, if you're dealing with a bank, in the POL, they'll break down and say, these ones are specific provisions, these ones are general provisions. The only provisions we add back are the general provisions. Please don't touch the specific provisions. Okay. Next one is what we call startup costs. Ladies and gentlemen, startup costs have two faces. They have two faces. They can either be added back or they can actually be subtracted. So you must know, when do I add them back? When do I subtract them? You only add them back if the examiner puts them in the POL. You only add them back if the examiner puts them in the PO. By the way, do not find yourself adding back something that was not coming from the PO, because by the word itself, I am adding back. It simply means you're adding back what had been subtracted. Now, the principle under startup costs is that when you incur startup costs, when a business is starting and you've not earned any income, these are costs that we call non-recurrent expenses, the pre-operational expenses. All businesses incur them. The moment the examiner tells you that these are non-recurrent or pre-operational expenses, you know he's talking about startup costs. Now, the principle is, if you incurred these startup costs, you cannot claim them in 1 year. But what would the accountant do? The accountant, for him, he wants to actually put them as expenses, and indeed they are expenses. So for him, he's going to put them as 100% as expenses. When the taxman sees them, the law says you can only allow 25%. So you only want to disallow 25, rather 75%, so that I can leave you with only 25%. So what do? If I found startup costs in your POL, I go to the tax computation and disallow 75% of that. By doing that, I am only leaving you with 25% that the law allows. That is when you're adding back the startup costs. When you add them, if they were in the POL, and you're adding back only 75%, because the law only allows 25%. If these startup costs were not in the POL, but were part of the notes, because there are items that could be part of the notes that are not in the POL. They tell you startup costs are 100 million, but they were not charged in the POL. Yet the tax laws allow for a certain percentage of those startup costs. So you're saying the accountant has not claimed anything, but the law allows him 25%. So what do? I calculate 25%, but this time I put it under this allowables. I hope it is clear. Please come in. The next thing, I told you now you're going to be winning twin marks. Twin marks. When I see unrealized foreign exchange loss, what comes into my mind is the opposite. Because the opposite is unrealized foreign exchange gain. But we also have what we call realized foreign exchange loss and realized foreign exchange gain. Now, two of them the accountant does not deal with them. 2 of them, the accountant is happy with them. If any loss or any gain is realized, the accountant has no problem, rather the taxman has no problem with it. If it is a loss and it is realized, it is allowable, don't touch it. You only touch it if they tell you it is unrealized foreign exchange loss. You add it back. If they are gains, if it is a realized gain, don't touch it. But if it is unrealized gain, please go to the tax computation and remove it. I hope that is also clear. We proceed. The other ones is where I want you to pay more attention because it gives you more marks. Expenditure or loss of domestic or private nature. And in practice, you know them. Those of you who are working. The director goes to the supermarket and shops for his family, brings you receipts and says, capture them. The director has gone on a holiday and brings charges and says, capture them. You're paying for water, you're paying for electricity, you're paying for utilities at the director's home, and he's bringing you the bills and saying, capture them, or it is the organization paying them. So, things that do not relate to the business. You have incurred expenses, but they do not relate to the business. Those are called items of domestic or private nature. What are some of the things that they have examined before that you can easily see in the exam? Number one, they are paying school fees for you, for the employees, or for the director's children. They are actually MD's personal expenses. This one is very common. Funeral expenses. All of us lose our staff and we contribute to their funeral expenses. Those are private in nature. Holiday expenses, sponsorships, subscriptions to non-professional clubs and associations. So when I say non-professional, it means if they are professional, they become allowable. If they are non-professional, they don't become allowable. And I'll give you an example. ICPA is a professional association. Uganda Manufacturers Association is a business association. So if you made any subscription to those that are professional or business associations, it becomes an allowable deduction. But if you made any other subscription, they made the subscription to Uganda, rather to Kampala Club for the MD, Golf Club for the MD, Rotary Club for the MD, Gym Club for the MD. Those are the ones that we are calling non-business associations or clubs. The expense is non-allowable. Bribes, kit kidogo, non-allowable. General expense is not supported by relevant documents. If the examiner tells you that this expense was not supported, he's actually telling you it might have not even been a business expense. Things to do with dividends shareholders. Dividends shareholders are not expenses. So these are some of the areas that they have examined before, and I thought it is very important for you to pick them. So those are expenditure or loss of domestic or private nature. We also have expenditure or loss of capital nature or included in the cost base of the asset. Pay attention here. This one gives you 2 marks. Why does it give you 2 marks? When you find any expenditure of capital nature, expenditure of capital nature means what? That it is supposed to result into an asset. You bought an asset, but instead of taking the cost to the balance sheet, you're putting the cost where? In the POL. When you see any cost of capital nature in the POL, please go and add it back. That is mark number 1. But as you add it back, remember that it is a capital expenditure, and largely speaking, capital expenditure qualify for capital allowances. So you must ask yourself, if I have added it back because I'm saying it is not an allowable deduction, what is the capital allowance I should give it? If it was a building, you go for IBD. If it was plant and machinery, you go for wear and tear. But you first add it back and then take it to the right place, calculate capital allowances. Those are the 2 marks I'm talking about. Next is expenditure or loss recoverable under any insurance contract or indemnity. Every time you incur a cost, every time you incur loss, but it was insured, you cannot claim that loss because already it is insured. I have lost my stock. My business has been burnt. My so-so has been destroyed. But was it insured? If the answer is yes, then you have not made a loss that should be allowed for tax purposes. But if, for example, you made a loss of 100 and the insurance company is only able to cover 80 million, it means the 20 that is remaining can be allowable deduction. Okay, next is income tax payable in Uganda or outside Uganda. And this is normally they test you on withholding tax. You paid some withholding tax or you paid some VAT and they want you to claim it, or they have the accountant has put it as part of the expenses, or you paid some provisional tax and the accountant has captured it as an expense. Ladies and gentlemen, tax is not an expense because we cannot give, for example, an expense for paying income tax and yet we are looking for income tax. So if you paid any tax, say for example VAT, say for example income tax, if you paid any withholding tax, we will not allow it to you as an expense. But we'll come back if it is withholding tax, we allow it as a credit. So remember that. Next is any income carried to the reserve fund. Those are provisions. Every time you create a provision, you're carrying. Gifts made to individuals. All of you are going to receive Christmas vouchers. Some of you have been asking me, are Christmas vouchers taxable? Yes, they are taxable. We either tax it on the employee. If we don't tax it on the employee, it can't qualify as an allowable deduction. So generally speaking, every time you're giving your employees those gifts, you know that the cost is not an allowable deduction. Next, that is very common, fines and penalties. Is there anyone who has done a number and you don't find fines and penalties? Every time you find fines and penalties, please add them back. Next is NSSF or any contribution to a retirement fund other than NSSF. Usually, when we are contributing to NSSF, we contribute 15%, not so. But the 15% has come from two places. The employee has contributed 5% and the employer has contributed 10%. What is allowable on the employer is only the 10. The 5% is not allowable. So if they put in the POL a whole cost of 15%, it means the company is claiming an expense that is also not theirs because the 5% came from the employees. The challenge that students find here is separating the 5% and the 10%. They've given you 1 million and they tell you part of the 1 million is 5% for the employee and part of the 1 million is the 10%. For you to get the 5% to disallow, you get 5 out of 15 and not out of 100. 5 out of 15 times the amount they have given you, and the amount you get represents 5% of the employee, and that's what you're adding back. Every time, because when students know that it is 5%, everyone thinks that 5% is over 100. But you see, it is 5% of the 15%. So don't make that mistake. Next is life insurance premiums or similar payments. Every time you pay for insurance, and it's called life insurance. Guys, listen. When I pay for life insurance of my staff, it is an unallowable deduction. When I pay for any other insurance, medical, group insurance, it is allowable. But when it comes to life insurance, it is an unallowable deduction. So when you see a life insurance, please add it back. Next is pension. If you incur any cost of pension, because we don't tax pension income, we also add it back. Now I want you to listen to these two that are following each other. Expense above 5 million from a supplier who does not have a tin. Haven't you seen common numbers? So if they tell you that you incurred an expense, and even if you have paid for it, but the supplier or the service provider did not have a tin, and the amount are above 5 million, the whole expenditure, you add it back. So an example, I come and buy goods on the street, and they are worth 10 million, for example. If they ask me for the tin of the supplier or the service provider and I don't have it, that expense becomes an unallowable deduction. The whole of the 10 million, even if it is 5.1, because the law says as long as it goes beyond 5 million, the whole expenditure becomes non-allowable. So if it was 5.1, I add back all the 5.1 because I have violated the principle. The other one that you must be careful with are expenses that have been incurred from persons who are registered for VAT but are not supported by invoice. By the way, in the exam, sometimes the examiner can cheat for you exams. If you realize that an expense should be allowable, but they have put a condition, for example, the supplier did not have an invoice, even if you don't know what it means, at least gamble and say this statement looks negative. It means the examiner wants me to add it back. Because in the exam, you use all the kind of knowledge, whether it is intuition, whether it is learned, whether you have seen it or not seen it, you must reason. So if the examiner puts any negative statement on a transaction, please, the highest bet is that he's saying, take it to the tax computation. If it is an expenditure, add it back. If it's an income, remove it. If you're not sure, that is the highest bet. Because then I have no reason for putting this negative statement on an expense that I thought would be allowable. I have already talked about provisions. Amortization is the same as depreciation. Depreciation is for tangible assets. Amortization is for intangible assets. But I want you now to pay attention on this amortization. The moment I see amortization, what comes into my mind? An intangible asset. Not so. Because we can only amortize intangible assets. So the moment I see amortization, I am aware that the taxman also allows an allowance or gives an allowance for persons who have incurred costs for intangible assets. And section 30 says that if you actually incur a cost for an intangible asset, how do we give you an allowance? Because an intangible asset is a long-term asset. So how do we give you an allowance for it? We get that cost of that asset, that intangible asset, divided by a useful life. That we get is what we allow. So in the exam, if I find amortization, I first add back amortization, but I go ahead and calculate the capital allowance on an intangible asset by getting the cost of the asset divided by the useful life. So if you see the examiner giving you software, giving you goodwill, giving you items that brands, and he has gone ahead to give you useful life of those items, he's actually saying calculate capital allowance for that intangible asset, because then he has no business giving you the cost and also giving you the useful life. So if you see an item of intangible asset and they are giving you the cost and the useful life, first go to the POL and check, did they calculate in amortization? If the answer is yes, I first add that back. That is one mark. Afterwards, I come and calculate capital allowance for that intangible asset. How? Get the cost divided by the useful life. Whatever I get, I come and put it under less allowables. By the way, this is how it is done. Any allowance that is not yet given by the accountant, any expense that is not yet given by the accountant, but the tax law allows it, when you discover it, you put it under less allowables. I repeat that. Any expense or any allowance which is allowed under the tax law, but the accountant did not claim it in the POL, when you get it, you put it in the tax computation under less allowables. Because that line of less allowables is a mixture of incomes and expenses. Okay, we proceed. Just like when you see depreciation, because we said we are adding back depreciation also. When we add back accounting depreciation, we remember two things. Because that depreciation we've added back is what the accountant had allocated for capital expenditure. Now, what does the taxman calculate for you? He calculates for you wear and tear and IBD. So in your mind, know that every time I add back depreciation, I am reminded to go back and calculate wear and tear and IBD. And wear and tear IBD, I will allow them because I have disallowed the accountant's depreciation. Once you master that, it is easy for you to coordinate it. The next one I want to talk about is impairment of assets. Whenever there is any impairment, impairment is a non-cash expense and therefore must be added back. Quickly, I am going to talk about this next one. Expenses purely related to rental income. Ladies and gentlemen, open your nostrils, open all your holes now. There is a 99% chance that whenever they give you number one, they put in an element of rental income. There is a 99% chance that whenever they give you that number one, they put in an element of rental income. And it can earn you at least 3 marks. So how do you earn the 3 marks? When you see rental income in that number one, that rental income will also be followed by expenses related to that rental income. So what do? You get the rental income, go to the tax computation and remove it under less allowables. And then look for the expenses that are related to that rental income and add them back. After you have done that in the tax computation, go on the site and calculate rental tax. And I'm going to tell you the principles of calculating rental tax. But the procedure is, I subtract the rental income, I add back the expenses related to rental income, and then I go and calculate rental tax as a working. Expenses related to rental income is not rent expense. I think I've said that over and over again. Rent expense is you're the tenant. Expenses related to rental income is that you're the landlord, but in the process of earning rental income, there are costs that you incur in generating that income. So do not mix the two, because rent expense is an allowable deduction. So do not see rent and say, this should be the expense that Julius was talking about. No, I am talking about expenses related to rental income and not rent expense. Now, those are the common items that you're going to see in your add backs. Those are the common items you're going to see in your add backs. Now, we got what you're going to see as the common items in your less allowable. The first warning is that that heading of less allowables is not referring to expenses that are in the POL which are allowable. I am going to repeat that statement because that's where I have seen, when we are marking, that's where I see students misfire. The moment they say less allowables, the student remembers that when he was actually in the POL, he saw things that were allowable and then brings all of them into the less allowable. So do you know what you're doing? You're actually giving this business a double deduction because they have already claimed it in the POL and you're now allowing it the second time. So what are the things that are accommodated under this heading called less allowables? Number one, they are incomes, but which incomes pass through the POL? If an income did not pass through the POL, please make sure you're cautious for you to bring it here. Number two, they are what we call the exempt incomes. Those are incomes again that have passed through the POL, but they are now exempt. So any income, in general speaking, any income that is in the POL, and you're satisfied that it should not be part of the gross income, is when you bring it under less allowables. Number two, when you want to bring any cost here, any expense here, it should not be in the POL. Listen properly. If you want to bring any expense under less allowables, it should not be coming from the PO. So then what could be the expenses that I'm going to put under less allowables? Those should be the allowances that are allowed under the tax law, but the accountant has no idea about them because they are not accounting transactions. Things to do with wear and tear allowance, things to do with IBD allowance, things to do with the allowance for intangibles, things to do with horticulture, things to do with greenhouses. Those are not things to do with minor capital equipment. Those are not items of the accountant. They are creatures of the income tax. And you will not see the accountant claiming them as expenses. But because you know that the taxman allows them as allowables and the accountant has not yet allowed them, you come and consider them here. So you must now, if you're to cram, these are the things you cram. And when you see them, come and knock them. Please cram these ones if you will not understand them now. I told you, whatever you don't understand why we are removing, first remove it. After 11th, come back, I will tell you why you removed it. Number one, the moment the examiner tells you that this income is exempt and it was pressed in the POL, please come to the tax computation and remove it. Number two, and that is very common, rental income. The moment you see rental income, and sometimes they call it property income, the moment they tell you that this business is also hiring, is also earning property income or rental income, they have a property, an immovable property that they are actually hiring out, whether it is land or building, you know they are earning rental income. And if it was included in the POL, please come to the tax computation and knock it out. If you don't understand why, again, I told you, I'm only going to explain it after 11. Next one, we have talked about it. Profit or gain on disposal of assets. Please, if you find it in the POL, come and knock it out. I want first to deal with income. So first, skip the capital deductions, skip the scientific research, come to and realize foreign exchange gains. Now for you, what you would be doing now at this point is summarize those incomes. What are those incomes that when I see them, I must actually knock them out? Exempt income, rental income, gain, profit or loss, or rather gain on disposal of assets, and realize foreign exchange gain, reduction in provision for bad debts, reduction in provision for bad debts. The other one related to bad debts is bad debts recovered. Bad debts recovered. The moment you see bad debts recovered, if it is a note and they have not yet included it in the POL, you come and include it because now we are going to tax it. If it is already in the POL, don't touch it because we are saying it should be taxable. Listen again, I want to explain it. When you have a bad debt, we allow it as an expenditure, not so. So after some time, after we have given you that deduction, assume you recover that debt. Shouldn't we tax you? Yes. So when you recover bad debt, it becomes taxable income. So what does it mean? If we find it in the POL, don't touch it. If you find it in the POL, don't, because we are meant to tax it. If it is not in the POL, Definitely it will be in the POL, because for accountants, when they recover it, they actually recognize it as incomes, and it is taxable income, so do not touch it. Reduction in bad debts, please, is income in the POL, but is not taxable. Now, there is this line. Because I was saying there was 99% chance. For that line, there is 100% chance. There is 100% chance that they are going to test you on incomes that have suffered withholding tax as a final tax. And if you have ears now, open them properly. Because I am going to talk about them in the hands of an individual, in the hands of a company, and in the hands of a partnership. It is only one income in the hands of a company that suffers withholding tax as a final tax under Section 139 of the Income Tax Act. And that is the only income you can bring to the tax computation when it comes, and it will always be in other incomes in the POL. And that income is called interest on treasury bills and government securities, whether treasury bonds or treasury bills or any other government security. That interest the company earns has suffered withholding tax as a final tax. So the moment I see it in the POL, what do? I go to the tax computation and remove it. And that is the only income you'll be dealing with when you're dealing with the company. What are the tricks of the examiner? You bring interest from a financial institution. For example, he earned interest from a fixed deposit account, and you see the student taking it to the PO, to the tax computation. You're finished. The only income is what? Interest on treasury bills and other government securities. Nothing else. Now, when it comes to an individual with partnership, they have four. When it comes to an individual or partnership, they are treated the same, and they have these four items. When you see them in other incomes and you're dealing with an individual number or a partnership number, please knock these items out. Number one, interest on treasury bills and government securities. Number two, interest from a financial institution. Number three, dividends. Number four, commissions for airtime distributors and airtime distributors, mobile money agents and airtime distributors. So four things. They are only applicable on an individual and a partnership. Interest on treasury bills or other government securities, interest from a financial institution, say for example on a fixed deposit account, dividends, and commission to mobile money agents and airtime distributors. Those are the four items that when you find them in the POL, please go to the tax computation and remove them if you're dealing with an individual or a partnership. If you're dealing with a company, only one item, interest on treasury bills and government securities. Don't say I did not warn you. Now, we are done with incomes that are common in the tax computation. And the warning is, for you to be able to remove the income here, you have confirmed that it is in the POL. And usually these incomes are in other incomes. Number two, we said there are other deductions which the accountant did not consider, yet the taxman considers them. And those are called capital deductions. What are the capital deductions you must be aware of? I have broken them down for you. And these ones are going to be calculated by yourself. So you must know, when do I calculate these deductions? And after I have calculated them, where do I take them? Because they are called capital deductions. Number one that you must calculate and you will not miss is wear and tear allowance. Where do we calculate it from? From the wear and tear schedule. Number two, industrial building deductions. You're going to calculate industrial building deductions if there is a building. Number three, I have already talked about startup costs if the accountant did not consider them. And here we are talking about 25%. The next one I have talked about is cost of intangible assets, the allowance for intangible assets. Then the other one that is common is to do with farming. Under farming, we have two things that you must remember. Number one is called horticultural plant, and another one is called a greenhouse. Now, if you see horticultural plant or a greenhouse, you know that you must go ahead and calculate capital allowances for them, and the capital allowances is just 20% of the capital expenditure. Just calculate 20% of the capital expenditure and take it as a deduction. In addition to that, you'll also be able to see things like scientific research expenditure. If they tell you there's a scientific research expenditure and the accountant has not yet allowed it, please come and allow it at that point. The other thing that you remember is called a minor capital equipment. I have given you additions during the year. This is how they test minor capital equipment. I have given you additions of assets during the year, assets that were purchased during the year. But one of the assets is less than 1 million. If one of the assets is less than 1 million, the examiner is speaking into minor capital equipment. Now, take caution. Those shares that you're seated on, if the cost of each is, say, for example, 700,000, it becomes a minor capital equipment. But even if you multiplied 1,000 shares and each of them is less than 1 million and you got 10 billion, that 10 billion would still qualify as a minor capital equipment because each of the items is less than 1 million. Are we together? So do not look at the total and say, but Julia said it must be less than 1 million. If each of the items is less than 1 million, it means the total also qualifies as minor capital equipment. Okay, so now, after getting the three items, because the three items was my profit or loss before tax, which I put in the last column, I then got all my add backs and got the total of the add backs and also put it in the last column, and then I get my total of less allowables. I also put it in the last column. How many figures do I have in the last column now? How many figures do I have in the last column? 3. So the 3 figures are going to give me chargeable income. And that is my mark number 1, or my result number 1. By getting the profit or loss, I add the total of add backs, I subtract the total of allowables, I get chargeable income. My warning is the less allowables must be put in brackets. Less allowables, put them in. It doesn't matter about the English. Some people say, since you've already said heading less allowables, I don't put it in brackets. You will forget and add them. You forget and? So whatever you say, less allowables, please put it in brackets so that you know you have to subtract it. And then, once you have your chargeable income, ladies and gentlemen, these are the things that will actually reduce your chargeable income. And remember them, because some of them are pre-marks. Number 1, is what we call a carry forward loss. In the exam, if they are going to test you on carry forward loss, they are going to tell you the loss from the previous year is this much. That's why I call it a free mark, because the moment you know where to place it, you're not going to do computation of carry forward loss. All you need to know is where do I then place it. So if you have any carry forward loss, you knock it off from the other chargeable income. By the way, at this point, you could even have negative chargeable income. Do not stop there. Even if it is negative, go ahead and remove the carry forward loss so that the negative becomes bigger. But when it comes to the adjusted chargeable income, which is the chargeable income minus the carry forward loss, if this adjusted chargeable income is a negative, please do not remove the tax. Do not compute tax. If that adjusted chargeable income is negative, please do not compute tax, because we don't compute tax on negative chargeable income. It simply means you have a loss. But if it is a positive and you're dealing with a company, what do? You apply 30% and you'll be getting tax payable. If it is an individual number, this is where the difference comes in. If it is an individual number, get out of that computation, go and look at the back of your exam paper, their individual income tax rates. Individual income tax rates. So for the individual, do not apply 30%, but rather get that adjusted chargeable income and go to the individual income tax rates and see where that chargeable income falls and use the formulas in the adjusted, rather the individual income tax rates. Those rates that we use for pay as you earn. I hope everyone has looked at them. So do not mess it up here when you're dealing with an individual, because here the individual and the company are totally different in terms of the rate. The company, I apply 30%, whereas an individual, I am going to go to the table and calculate the tax on the side and then bring the tax here when it is already calculated. For the company, I get 30% directly on the adjusted chargeable income. The moment you get the tax payable, it means now you're looking for things, or what we would call credits, that will reduce the tax that you should ideally pay to URA. And there is one exceptional deduction or credit from the tax payable. That 2%, you can cram it or leave it. For now, I have only seen one exam, I think, where they told you the company you're dealing with is a company that employs persons with disabilities. That is when it becomes relevant. So if you're reading an exam and then the examiner says, this company employs persons with disabilities and they form more than 5%, at least 5% of the full-time employees, then you remember there is that marker that you must win. And this is the time when you actually win it. Because after getting the tax payable, that company is given another privilege, another special allowance, that before they pay all this tax, they calculate 2% and remove it from the tax they should have paid for having employed persons with disabilities. But generally speaking, there are not very many that will make 5%, because 5% of your full-time employees, and there are people with disabilities. It means you must have intended to actually benefit from that. So this 2% is not so common. But even if it comes and you're that person who wants to get to the 80%, you must remember it. Yes. Now, assume this company does not employ persons with disabilities. It means immediately you get to the tax payable, you then remove what we call the credits. And there are only 3 types of credits that you must remember. And all of them are free marks. Why do I call them free marks? Because the examiner tells you the statement, gives you the amount, and all you need is press them in the right place. So what are these credits? Number 1, foreign tax credit. Foreign tax credit is tax someone has has paid outside Uganda. You earned income from Uganda, they charged you some withholding tax, for example, and now it is time to claim it because we are taxing you on your worldwide income. Number two, withholding tax that you paid, both at importation and also local. The moment they withhold from you and that withholding tax is creditable, this is the time you claim it. And the examiner is going to tell you the withholding tax was this much. It was either incurred at importation or incurred on the local market. Number three is provisional tax paid. They will tell you during there, you paid a provisional tax of this much. So those three are the ones that you knock off from the tax payable for you to be able to get the outstanding tax liability. Now quickly, please, I told you you're not going to get tired. Note, I am now going to get you through the specific notes which the examiners have tested before, and I want you to master them. So note number one, individuals also use the same format above, but the tax rates differ. And I told you the tax rates are the individual income tax rates. The other item that differs between an individual and a company is that when it comes to add backs, all the things that we added back, you add them back. But in addition, I add back all the costs that have gone to the sole proprietor. Remember this. If it is an individual, it means that he is a sole proprietor. You are a person and your business is under you. Now, all the costs, any money that you pick from the business, whether it is for your fuel, whether it is for your rent at home, whether it is for your travel, whether it is the salary, as long as it is money that was spent on you as the owner of the business, all that becomes non-allowable. Because as a sole proprietor, you're supposed to wait for a profit. And therefore, in determination of the profit of your business, any cost that you actually incurred on yourself are add backs. We add them back because we want to determine the chargeable income of the business and not you. That's why every cost that you incurred on yourself as a sole proprietor is added back. Now, again, when it comes to an individual, before I leave the individual is capable of earning. They are going to give you a number, and I've seen it in paper 17 more often. They give you an individual who has business income, but also has employment income, and also has probably property income. All they are saying is look for the chargeable income under each of the incomes and then add them together. So if I am an individual and I earn business income, I first look for the chargeable income under business. If I am also earning employment income, I also get the chargeable income under employment. And then I combine them before I tax this individual. I hope that principle has also sunk. Okay, let's first proceed. So what are the other enabling formats that you remember while you're in the exam? Of number one, remember? So the other things that you remember, one student, I think when I asked you to actually list the things that you would want me to talk about, someone talked about interest capping. I am very sure all of you have heard about interest capping. And usually for number one, I intend to spend 2 hours on number one because once you master number one and you have passed it, there is no way you can fail to get 50% in that exam. That's why I spend more time on number one. So, when do you do interest capping? When do you do interest capping? Ladies and gentlemen, interest expense is an allowable deduction. Not so. If you find interest in the POL as an expense, and it's normally called finance costs, if they have not put a note on the finance costs, do not bother about it. It means it's a normal expense, and that is where interest is covered. But the moment they put a note on finance costs, remember these two things. The examiner could be testing these two things that he wants you to deal with in the tax computation. Number one, because we said finance costs to represent largely interest expense, not so. Of course, with other costs like bank charges and etc. But largely we are talking about interest. It means when they put a note on finance costs, the two things that are outliers, which should be knocked out of the POL as non-allowable, are two. Number one, he's asking, could that interest be a capital expense? How does interest become a capital expense? If that interest relates to a loan, which loan was used to acquire, to construct a non-current asset. In accounting, we call it a qualifying asset. And under IS 23, we said that interest is a capital expense. Because it is a capital expense, the taxman also realizes that that interest should not have gone through the POL, but rather should have been added on the cost of the asset. So if I find it in the POL, what do? I do two things. I get that proportion that is capital in nature and add it back. After adding it back, I ask, what was it related to? For example, construction of a building. So I must go and add it on the cost of the building before I compute IED, because I'm putting it from the POL and capitalizing it. And when you capitalize an expense, means you're adding it on the cost of the asset. That is interest number one, that is capital in nature. I add it back in the tax computation, but I go and add it on the cost of the asset before I compute any capital allowance. Interest item number two that the examiner is going to test you on is interest, where they tell you that ABC Limited is a member of a certain group of companies, or ABC is a subsidiary of ABC International. And they are telling you that they actually exchange loans, or that they have actually acquired loans. When we see loans acquired by the member group entities or the group member Okay, sorry, every time the network gets out, I am muted and they have to rectify that. So I hope you can hear me again. Guys online, confirm that you can hear me again. So I had
Yes, we
covered the
can
part
hear you.
of capitalized expenditure, another capitalized interest. We said you add it back and then add it on the cost of the asset. The other part of interest that they could examine you on is interest that is coming from group loans. When you actually discover that these loans are coming from the group members or this company belongs to a group, then you know that the examiner is testing you on interest capping. What is interest capping? They are saying that every time you are a member of a group and you incur interest on loans, then that interest should never exceed 30% of your earnings, tax earnings, before interest, tax, and depreciation. It is a technical formula, but it's easy to actually get. All you need to know is that when I actually see that interest and I have to test for interest capping, this is the formula I have to go through. So that formula says that you start with chargeable income. Chargeable income means it's coming from your tax computation that you run. Meaning that that chargeable income that you should have put in your tax computation, you're not going to write it in the tax computation because you know there's something you need still test. So you first leave a row, which is interest, because you're thinking there's interest you want to add back, but you have not yet understood how much you should add back. So you don't write the chargeable income in your computation, but you write it on the side. After writing it on the side, you come and test for interest capping. How do you test for interest capping? You come and get that chargeable income from your computation, the tentative chargeable income, and then you first subtract. If you carried the chargeable income, you first subtract carry forward losses. But if you brought the adjusted chargeable income, then you don't have to remove the carry forward loss. I thought that is very important because remember we have chargeable income and adjusted chargeable income. That adjusted chargeable income is affected by the carry forward loss. So if you carry the chargeable income, you have to adjust it with the carry forward loss. If you carry the adjusted chargeable income, then you don't have to bring in the carry forward loss. So what are the other items you must knock out? Now, knock out that interest which was coming from the group. In the note of finance, they will tell you this interest is the one that is coming from the group. First, remove it from the chargeable income. Remember, we are looking for the earnings, tax earnings before interest, tax, depreciation, and amortization. In other words, they're saying get the tax earnings before you have knocked out those items. So what we are trying to do is that getting the chargeable income, I first subtract the carry forward loss, if any. I then subtract the interest on the group loans as per the POL. What is coming from the POL? I also subtract it. Then I also subtract the tax depreciation, and the tax depreciation is both wear and tear and IBD. So I also remove them. And then if there is any amortization, which is now called the allowance for intangible assets, I also remove it because I am trying to get the earnings before interest, tax, depreciation, and amortization, and I'm talking about the tax items. So I'll be getting what we call the tax earnings before interest, tax, depreciation, and amortization, and it is from that figure that I will apply 30%. Once I apply 30%, it means I am getting the maximum of the interest that I can claim. Because the interest that I can claim is only up to 30% of the tax earnings before interest, tax, depreciation, and amortization. The moment I get that maximum, I then compare it with this interest that I had subtracted. So I am comparing this 30% that I have calculated with the interest that I had added back. If the interest I had added back is more than the 30%, it means I am claiming more interest, which is not allowed. So what do I add back? The excess. So assume this interest, say for example, was 120. But when I come and calculate the cap is saying only 100 is the maximum I can claim. It means in the POL, I had claimed how much? 120. What does the law allow? Only 100. So what is the excess that I had claimed? 20. It is the 20 that I add back in my tax computation. Have we fixed that? Good. That is formula number one that you must be aware of, and it is very common. Number two formula that I had talked about that you need to be aware of is to do with donations. Because we said with donations, you test two things. Is the organization correct? And I talked about the 5 organizations. And they must have a certificate of exemption. Once that test passes, then the next test is, what is the maximum you should have given out as a donation? If the donation you gave out is more than the maximum, we add back the excess, just like we did for interest. So how do you determine the excess? You come back again, get your chargeable income. Get your chargeable income. And first go to the POL and ask, what was the donation that was knocked out in the POL? What is that donation the accountant is trying to claim? I first add it back as if I am disallowing the whole of it. Because every time you're adding back something on the chargeable income, you're assuming that you're disallowing the whole of it. And I am asking, the question I am trying to answer is, what was the chargeable income, or what would have been the chargeable income if this company did not give out any donation? So I first get that chargeable income before the donation. How did I get it? By first getting the chargeable income, go to the POL, add the donation back. After adding it back, I am now getting the chargeable income that is not affected by the donation. The law says then, I must apply 5% on that total chargeable income to be able to know the maximum donation I'm allowed to give out. Once I get to that 5%, then I compare this figure. Assume the donation that I gave out was 120 million. But the 5% is only saying 70 million. It means as a business, I am only allowed to give out a donation of 70 million. But what did I give out? 120 million. So what is the excess of what the taxman does not allow? 50. That 50 is what I go and add back. Now, there's always a dilemma student asking me, but what if I am actually given interest capping and I'm also given donations? What do I use? You use the chargeable income before you make these two amendments, before you make these adjustments, because you're starting from the original chargeable income. What was the original chargeable income? So if you do, of course, there's going to be a misnomer. There's going to be some mismatch. Ideally, we would have guidelines on what should I actually first knock out before I get my new chargeable income. And the good examiner would really not test you on both the interest capping and also on donations. But in reality, it actually happens. You're going to find someone who has given out a donation, but also someone who has calculated the donations. If you go to the law, for example, some people argue interest is under section 25. Donations are under section 33. Probably I would first knock out the interest and then I calculate the chargeable income and then I consider the donation. But my opinion is, once you have the original chargeable income, use it on both formulas, and that will not make your answer wrong, because the examiner will also appreciate the dilemma that you have. He has given you two adjustments that are all using the chargeable income. Okay, that is the second formula. The third formula, I had talked about it. When you're calculating startup costs, especially when they have not been in the POL. The cost of intangible asset, I had also talked about it. How do you get the capital allowance? Get the capital expenditure over the useful life. For the greenhouse or horticultural plant, if you want to know the capital allowance on greenhouse or horticultural plant, just get the capital expenditure times 20%. Then there is another item under farming that you must be aware of. It's called farmhouses. By the way, there are 4 things that you must be aware of when it comes to farming. 4 things, remember these ones. When it comes to farming, there are 4 things that the examiner can test you on. Number 1, he can test you on farm works. He can test you on farm works. Number 2, he can test you on farmhouses. Those are different. Number 3, he can test you on horticultural plant. Number 4, he can test you on greenhouse. Now, master how they treat them. If they are farm works, and I'll show you what qualifies as farm works. The moment you they qualify as farm works, you take them under the wear and tear schedule under class 3. I repeat this. The moment you're dealing with anything to do with farming, there are 4 things that the examiner is interested in. Number 1 is what you call farm works. So when you understand that they are testing farm works, you take them to class 3 of the wear and tear schedule. Number 2 is what you call farmhouses. Farmhouses qualify for IBD. So you won't take them to the wear and tear, but you're going to calculate IBD. Number 3 is horticultural plant, and number 4 is greenhouse. So how do we choose them for tax purposes? Farm works, wear and tear, class what? Class 3. Farmhouses, calculate IBD. Horticultural plant and greenhouse, for them, it is easy. Just apply 20% on the capital expenditure and take them to the tax computation as an allowance. So, again, for IBD, you know how IBD is calculated. The next item that has confused students that I actually needed to talk about is what we call returnable containers. I am very sure you have seen returnable containers. And sometimes the examiner has actually confused students the more. Returnable containers, mention them. You have crates of beer. If you're a depot and you have crates of beer, those crates of beers are not yours. They belong to the company that you're dealing with, not so. Those of you are in business. That's an example of returnable containers. Now, those returnable containers are not supposed to go to the wear and tear schedule. They are not supposed to go to the wear and tear schedule. So how should you treat them? We have what we call the diminution. Diminution is like loss of value of those returnable containers. So section 26 says that when you have returnable containers, they are not your assets, but you're going to get an allowance on those assets called the diminution cost. And how do you calculate the diminution cost? Every time the examiner gives you returnable containers, he should be able to give you what you call the diminution rate. And you get the diminution rate multiplied by the cost of the returnable containers, and that you get is what you take as an allowable deduction under the allowables. If the examiner has given you returnable containers and he has not given you any diminution rate, where do you resort to? You resort to the last item in class 3, which is at 20%. And you must make your assumption. You tell the examiner, you have not given me the diminution rate. I am assuming that I am actually going to allow a diminution rate, which is the lowest rate in the wear and tear. Putting it in the wear and tear, I still say, is not right, because section 26 does not allow us to take it to the wear and tear. If the examiner has not given you the diminution rate, please you can apply 20%, but make an assumption clear. Okay, quickly, I want to run quickly to the wear and tear schedule, and then IBD, and then we have a small break. So I am going to talk about the wear and tear because we said you must draw the wear and tear schedule. Whether you want it or not, you must know how it goes. And the wear and tear schedule has basically, you will still draw how many columns? 1, 2, 3, 4, and 5 columns. Column number 1 is going to be for particulars, description, details. We are going to put the items. Column number 2 is going to be for class 1 items. Please, ladies and gentlemen, if you've never mastered these percentages, remember them. Because we have students who have come from history and they are now in present. You are in history where there was 40%, 35%, 30%, and 20%. We are now looking at the present. The present, class 1 is 40%. Class 2 is 30%. Class 3 is 20%. Please, we do not have any other class. Whereas your past papers, whatever you have looked at, some of them had 4 classes. We now have 3 classes, and also the percentages have changed. These percentages are not given in the exam. That's why I'm emphasizing that you must cram them. Class 1 is 40. Class 2 is. Class 3 is. The next thing is you have now to know which items go to in each class. Before you know the items that go to each class, can you know how this runs? When you get in the wear and tear, there are marks that are free. So which marks are free? Number 1 mark is the tax written down values, balance brought down. These are the figures that you're given in the exam question. This note, for example, where is the note? You see this note number 8? This note number 8 is telling you class 1 is that. Class 2, there is nothing. Class 3, there is an amount. Again, that is where you cheat the examiner. The moment the examiner is telling you there is no balance in class 2, your mind should automatically switch off from class 2. It simply means there is a likelihood of no asset being in class 2, because class 2 is a unique class. So when the examiner has given you no balances in class 2, and for you rushing to put assets in class 2, then it means you're not using the other sense, the 6th sense. And I told you in the exam, you actually need to open up all the senses. So the moment they give you classes and there are no assets in class 2, assume for now, until you become more technical, assume for now that even additions will not have assets in class 2 as a safety zone. If they give you assets in class 2, you also need to be sure that there are going to be additions in class 2. That is for purposes of helping you pass. When it comes to you understanding what goes into class 2, then you improve that understanding. But for now, let's see what goes in. Now, the moment you bring those balances, all you have done in the tax, rather in the way Antia showed you, is just get the totals. Because the figures, you just pick them the way the examiner gave them to you. Whatever is in class 1, place it in class 1. Whatever is in class 2, put them as opening balances. Now, as you put the opening balances, usually in the exam question, the next statement is saying, would be saying, for example, if I can pick, these are assets that were purchased, they are assets that were purchased and assets that were sold. So they will tell you, during the following assets were acquired. For example, if I look at this, let me show you the common language. Now, you see this statement 11, it says, the following assets were acquired during the year. It simply means they are telling you the additions now. Now, your only role is to see the assets and understand which class you should put it in. So we are in additions. Under additions, you're listing all the assets that you have purchased during that very year. And you must know where to place certain assets. Ladies and gentlemen, class 1 only accommodates computers and data handling equipment. Do not expand your definition of data handling equipment. Data handling equipment has in scope servers. It is either a laptop and a desktop and the server. Anything that you want to call a computer, please put it in class 3. Whether it is a printer, whether it is a projector, whether it is an ATM machine, whether it is whatever you would want to call it, whether it is a camera, please put it in class 3. Class 1 is strictly limited to computers, what you'd call a computer. Unless the examiner now says computers and printers together, it means it is just a workstation combined. Then don't get confused and say, but printers are supposed to be in class and they have not. Sometimes the examiner will actually call them computers and printers. So there you're stuck. You must place them in class 1. But largely speaking, class 1 accommodates only computers and data handling equipment, and data handling equipment simply means servers, from the experience that we have had. After putting in the additions, and I'll show you quickly where they fall. After putting in the additions, the next thing you put in are disposals. So what principle do we get here? That we normally dispose of the assets before we charge them depreciation, because we are looking at the assets that are at the end of the year. Meaning, an asset that is disposed of during the year does not suffer depreciation. And here comes when you're also computing, for example, capital gain on a business asset that had to acquire some depreciation. You don't depreciate it in the year of disposal. Why? Because the wear and tear is already telling you that you cannot compute depreciation unless you first remove disposals. So after additions, you remove disposals. You remove disposals that have been disposed in any class. And then finally, you want to know which assets have remained in each class, what we are calling the net assets. It is on the net assets that then you apply the percentages. So the formula is opening balance. I first add the additions, I remove the disposals, and whatever remain with as the net is where I apply the percentages. So do not apply the percentages unless you have this net, and that net is opening balances plus additions minus disposals. Once I get this net, then I say class 1, I apply 40% on that net. Class 2, 30% on that net. Class 3, 20% on that net. And I'm able to get the depreciation allowance that you're calling the wear and tear allowance. When I get it, I take it to the tax computation. Because we've also seen students, they draw the wear and tear. For them, they were told, draw the wear and tear. They get the depreciation allowance and leave it hanging there. When you get this depreciation allowance, take it to the tax computation under where? Under less allowables. Good. And then you can go ahead and get the closing balances. How do you get the closing balances? Net minus depreciation. You get the net. You have closed your wear and tear schedule. Now, quickly, and I am going to just run this for your purpose. What are the things that you like to find in your class? 1, computer printing press. That will actually be in class 1. Computers and printers, I told you sometimes they combine it. So when I combine it, it does not mean that printers are actually part of class 1. If they separated both, if they said computers and then printers separately, I would put printers in class 3 and then put computers in class 1. What else? Computer servers, class 1. Desktop computers and laptops, class 1. And that is it in class 1. Now, ladies and gentlemen, class 2 is very, very unique. You will only put class 2 assets if you are aware that the business you're dealing with is in either of the three. When they give you a question and it is a farming question, the company is in farming, then you're sure you're going to have some plant and machinery in class 2. If they give you a company and it is in the manufacturing sector, you know that you're likely to have plant and machinery in class 2. If they give you any company that is in mining, then you're going to have assets in class 2. Because class 2 only accommodates plant and machinery strictly used in farming, mining, and manufacturing. If you're dealing with any other general company, please don't be tempted to put any asset in class 2. So what are the common assets that the examiner has asked before? For example, laundry soap making machine, soap mixer, conveyor machines. All those are machines in the industrial mixer, mattress making and trimming machines, galvanizing machines, manufacturing equipment, plant and machinery, coffee sorters, coffee processors, tractors, juice crushers, agriculture sprayers. Those are plant and machinery that is going to be used either in mining, manufacturing, or farming. Ladies and gentlemen, any other assets, as long as it's plant and machinery, let's throw it in class 3. So if you see an asset and you're not sure, and this business is not in mining, it is not in farming, it is not in manufacturing, throw any other asset that is not computer and data handling equipment, class 3. If I am given the opening balances and I saw that there is no opening balance in class 2, I only have to deal with class 1 and class 2. Whether there is an asset in class 2, I take that risk. But for exams, it is much safer to actually also follow the examiner's setting. And you'll be good to go. Okay. What haven't I talked about in the wear and tear schedule? 2 things quickly. In the wear and tear schedule, there are 3 concepts that you must remember. And the examiner tests them more often. One is to do with the road vehicle. Have you seen road vehicles? You bought a Land Cruiser, a Benz, a Harrier, whatever vehicle it is, as long as it is a sitting vehicle less than 13 passengers and it's not a commercial vehicle, we call it a roads vehicle. The law limits that only 60 million. Meaning if you bought a Land Cruiser of 300 million, the only amount you can put in class 3 is what? Do not put anything beyond 60 million if that vehicle is the vehicles that we know, the Land Cruisers, the mini vehicles, the saloon vehicles that we're talking about, vehicles that carry less than 13 passengers, we call them road vehicles. If their cost is beyond 60 million, you only restrict the wear and tear 60 million. Remember that. Principle number 2, if you come here on disposals, and the examiner tells you that all the assets in the class were disposed of, that statement triggers 2 items, either balancing charge or a balancing allowance. How do you know that it is a balancing charge? How do you know it is a balancing allowance? For simplicity, when I dispose of all the assets in a class, and which assets are they? Opening balance plus additions. Assume all my opening balance plus additions in class 1 are adding up to 200 million. But when I have chosen to dispose of all those assets, what? 200 million, but I'm selling them at 220. It means the assets that had a cost, that had a value of 200, I have disposed them at 220. Will I still have a value in net assets? I won't have a value in net assets because I have disposed of all the assets. But because I have disposed them more than their value, I have made a gain. That gain is not called a gain. It's called a balancing charge. It's called the balancing charge. That balancing charge, go to the tax computation and add it there. Because we want to tax it. That balancing charge is income that is taxable. That's why the balancing charge is added in the tax computation. The reverse is true. If the assets were worth 200, but I am selling them at 170, it means I have made a loss. That loss of 30 million is called the balancing allowance. Go to the tax computation and subtract it. So balancing allowance subtracted in the tax computation. Balancing charge added back. Quickly, last one. For number one, I'm going to talk about IBD and we have a break. Now, IBD, ladies and gentlemen, is on industrial buildings. And industrial buildings can be any of these. Either an approved hotel. Let's start with this. It can be a manufacturing operation. And the common one is a factory. You've seen questions. They're talking about a factory. Or a research and development into improved or new methods of manufacture, or a mining operation, you have a mine. An approved hotel business, someone is in a hotel business and they have a building. Someone has put up a hospital. Someone has put up a hotel building, has put up a hospital, or has an arcade, or any other building that we are going to call approved commercial buildings. We're going to see examples. The moment you see a building, anyway, the moment you see a building, what should come into your mind is that the examiner wants you to calculate IBD. So, what are some of the things that you must remember? The most common questions normally come on approved commercial building, and you must know what an approved commercial building is. The law says an approved commercial building is an additional building which is primarily used by the owner or let out for rent for the purposes of carrying on a business, trade, or profession, as an office, a warehouse, or a commercial storage facility, or a workshop. So if you see the examiner giving you an office, he's telling you it qualifies as a commercial building. If he's giving you a warehouse, it is qualifying. If he gives you a commercial storage facility, it is qualifying. If he's giving you a workshop, it is qualifying. But the common items usually are factory buildings. The moment you see a factory building, you know they are testing for IBD. So usually in the exams I've seen, they are either testing on an office or a factory. The moment you see such a building, you know they are testing for IBD. Now, be cautious. There are things that you must remember when you're calculating IBD. And I must emphasize them. Ideally, this is how we would be calculating IBD. This should actually be called the qualifying cost. Qualifying cost or construction cost for new buildings. Qualifying cost for old buildings. Okay, let me use this. Whenever they want you to calculate IBD, this is what you cram in the exam now. How do I know that the examiner wants me to calculate IBD? He gives you a building, whether you don't understand that it is a building or not, because there are certain structures that confuse people whether they are buildings or not. Like they have given you a boundary wall, and you're not sure whether it is a building or not. They have given you a fuel canopy, and you're not sure whether it is a building or not. So how do you know that this could be a building? If you see the examiner giving you the cost or the qualifying cost, and he's also giving you when it was first put to use, then you know that the language he's actually talking about is an industrial, because it is only industrial buildings that they are going to tell you when they were put to use. So you're looking for 3 ingredients, because the formula says A times B times C over D. One of them is obvious. A is obvious. A is 5%. When you're calculating IBD, the percentage is 5%. 5% of what? Of B. So what is B? This is why I want you to pay more attention. B, if it is a new building, and a new building means that I am dealing with a number for the year ended, say for example, 31st December 2024 or 30th June 2024. And that building was first put to use in that very year of income. It means if it was put to use in that very year of income, you're going to use the construction cost as your B. You're going to use the construction cost as your B. If they tell you that the building was constructed a long time, for example, 2019, 2020, 2021, 2022, the examiner must have given you a qualifying cost. Because for old buildings, we are talking about a qualifying cost. For the new buildings, we are talking about construction cost or the cost of construction or capital expenditure. So if you are dealing with an old building, you start from the qualifying cost if the examiner has given it to you. If the examiner has not given you the qualifying cost, and you know that that building was put to use before 1st of July 2023, buildings that were put to use before 1st July 2023, you would first get the cost, first knockout initial allowance of 20% of the cost for you to be able to get the qualifying cost. So the examiner could trick you and give you a building that was constructed before 1st July, before we scrapped off initial allowance, but they have given you the cost of construction and not given you the qualifying cost. So what do you do? Because it is an old building, you first get the cost of construction that was incurred then. First knockout, 20% as initial allowance. And that initial allowance, you take it nowhere. It is only for helping you get the qualifying cost. After getting the qualifying cost, that's when you multiply by 5%. Now, guys, old buildings, the moment they give you the qualifying cost, they have eased your work. All you have to do is multiply by 5%, you will have IBD. I repeat this. When the examiner wants to make your life easy, what does he do? He gives you an old building, and then he gives you the qualifying cost. What do you do? Multiply by 5%. That is all you have to do. If he wants to complicate your life a little bit on an old building, he gives you the cost of construction. And if he gives you the cost of construction and you know that the building was constructed prior to 1st of July 2023, there was initial allowance. So you first give that building 20% of the cost. So you first knock out 20% of that cost. What remains becomes the qualifying cost. It is what then you apply 5%. Are we together up to that point? Good. If it is a new building, and a new building simply means they have put it to use in this very year that you're dealing with. I am dealing with a number, and the examiner was saying, calculate the chargeable income and tax payable for the year ended 30th June 2024. And the building was also put to use in that very year because the year that ends 30th June 2024 started July 2023. Now, if I am given that building which has been put to use now in that year that I am dealing with, it means B, your B will remain the construction cost. The B will remain with your construction cost. But now you have to deal with C. Because C is asking, C over D is for helping us apportion. If this building was not put to use on 1st of July 2023, if you're dealing with the number of 30th June 2024, it means the year started on 1st of July 2023. For you to have 12 months, the building must have been put to use on the very first day of the year, 1st of July 2023. If the building was put to use after 1st of July 2023, say for example, in August, in September, it means basically you have not used this building for 12 months. And therefore you cannot claim the whole of 5%, because 5% represents 12 months. That's where you now have to come and do the time apportionment by getting C out of D. So the formula then becomes A times B times C over D. C over D is just for apportionment of days, because D is seated on 365 days. C is asking, have you used this building for all the 365 days? Definitely, if this building was not put to use at the beginning of the year of income, it means there are days it did not get to be used. So you start counting your fingers now. And we count in terms of months. Assume the year started in January, and we are dealing with the number of the year ended 31st December 2024. It means it started in January 2024. They put this building in use on the 1st of April 2024. What would be your C? Because C is testing the number of days this building has been in use, and it was put to use starting on 1st of April 2024, and the year is ending 31st December 2024. C is recognizing that there is a period from January to March when this building was not put to use, and the C is looking for only the number of days this asset was put to use. So you count your fingers starting from 1st of April up to the 1st of December. That becomes your D. Rather, that becomes your C. So what would you get? How many days would you? Please make sure you count them. By now, you must know which months have 30 days and which months have 31 days. If you forget, when we were in primary, we used to use our fist. The ones that are on top are 31. When you enter inside, 30. When you come up, 31. So you count and then come back. It is only August that is on top. July and August are both on top. Because when you come, you say January, February, March, April, May, June, July, then you come back to August. So that's why August is 31st. So whatever is on top is 31st. Whatever is inside is. Now the ones online have not seen my demonstration. But you must know how to calculate those days. Once you calculate those days, they become your C. And this is constant, 365 days. So your formula would be A, which is 5%, times B, which is the cost of construction, times C over D. Have you calculated the number of days? How many are they? 275. So if I had my C as 275, it would be 275 out of 365. We will be done with the apportionment. Ladies and gentlemen, there is no apportionment on old buildings, because the assumption is if the building has been there, even this year you have used it for 365 days. And it doesn't matter when the building was constructed. You're only dealing with IBD for one year. Do not, I have seen students saying, but if the building was constructed in 2019, so I should multiply by the number of years. No, each year of income is a separate year of income. Okay, finally here, the only thing I would want to talk about is an approved commercial building does not include a building let out or used for residential accommodation. If I have a building, I am doing business at the bottom and I am residing at the top. What do? I calculate the whole building IBD for the whole building, and then when I am going to allow the IBD, I only allow the IBD of the part where I'm doing business. The part of the accommodation, I don't allow it. So you calculate the whole IBD, and if they tell you the part that is used for accommodation is, say, for example, 20%, it means you knock off the 20% from IBD before you take it to the tax computation. I thought it was important for me to actually talk about that. I want to pause number 1 here and allow you go for a break. You forgive me, we will actually, unless you, let me see the comments that have come through. Quickly, if you have any questions, I am going to only pick 5 questions for number 1, and then we can move for a break and come back, because we don't have a lot of time. So let me see the questions that have come online first. Someone says, let me pick the questions. I can expand them here. Okay, I am not seeing questions. Okay, Dan says 5% of chargeable income, is it inclusive of the donation? No, we said you first get the chargeable income, first add back the donation, so that you have the amount that is inclusive of the donation, and then you apply the 5%. I think I explained that. Someone says, I didn't get the condolences clearly. If you have any condolences in the POL, you add them back. Not so? That's what we said. Someone says, I beg your pardon on provisions I missed. We said all provisions are non-allowable deductions except the specific provisions for financial institutions. Peter says, I missed life insurance and medical insurance. We said life insurance premiums are non-allowable, whereas medical insurance expenses are allowable. Jocelyn says, what if the useful life of intangible asset is not provided? If they have not given you the useful life of the intangible asset, you don't calculate the allowance for intangible asset. Someone says, what about the software or any intangible asset? Do you also capitalize it in the wear and tear? No, we do not take the software or intangible assets in the wear and tear unless they have told you that that software is a computer software. Please, the only software that goes into the wear and tear is the computer software. Why? Because the computer software is taken to be part of the computer. That's why we put it in class 1 where the computer falls. But any other software is an intangible asset where you're going to calculate it. And I told you the trick is, if the examiner wants you to calculate the allowance for intangible assets, he will give you the cost and also useful life. Someone says, I have already explained balancing charge. What else is coming in through? How about bad debts written off? I already explained that. We say bad debts written off are allowable. Amortization, we said you add them back. Which other questions came through? Okay, I can now hear from the physical class students. Do you have any questions? I will allow you only 3 questions quickly, and then we'll have a break. Remember, you're seated in your break. Any questions physically? Here? Yes. So 1, I want 1, 2, 3, and 4. I will done. Yes. 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 As long as they have told you that that interest is coming from the group loans, you'll have to do the interest capping, whether it is revenue or capital. As long as it's coming from the group loans, you'll have to do the interest capping. Only 1 question is what I allow, because we are running out of time. Yes. You forgive me, I can offline the questions, but let us cover as many areas as we can. Otherwise, if we allow everyone to ask, definitely we won't move. Yes. 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 You had removed what? Yes. We have, you see, we had first of all added back the accounting. We had added back the accounting transactions to do with depreciation, to do with amortization, to do with all those. We had added them back. Not so? But we have a problem. After adding them back, we came and created another problem under tax computation by allowing the the by allowing the wear and tear allowance, by allowing the cost of intangible asset, by allowing because the formula says tax earnings before interest, depreciation, and amortization. Now, if you come here, where is our formula? Up here. Hey, did we sub? This is an ad. My apologies, my apologies. Thank you so much. This would have been killer. Guys, what we are trying to do is get the chargeable income before these items, because we are looking for the tax earnings before interest, depreciation, and amortization, meaning we should be adding back these items. Oh God. Sorry. So these items had been subtracted, so we must add them back. That is how dangerous a formula can actually kill someone. Pardon? So this, first of all, what had we done to the carried forward losses? We had less them. So again, we add them back. Because you see, if we had not less them, so can we do this? Let's start from this. Adjusted chargeable income. Once we do adjusted chargeable income, it means we actually knock out this. And we are saying that this adjusted chargeable income, let me make it clear because I don't want you to fail on this, is chargeable income minus chargeable income less carry forward loss. Thank you so much for that. So if I am starting with the adjusted chargeable income, I will have to come and add back the things that I have subtracted. I will add back the interest that was knocked off in the POL. I will add back, this depreciation is not the accounting depreciation. It is the wear and tear allowance because it's what I have knocked off. And then amortization is not the amortization in the POL. It is the allowance for intangible asset that we had allowed under less allowables. In other words, the things that we had allowed under less allowables are the things that we are adding back. That was very major. Thank you so much. Any other? There was two, and then we close this. For suppliers, about 5 million from suppliers who are not registered. Yes. Individual transaction. For transactions above 5 million, it must be an individual transaction. If you make an individual transaction with a supplier who has no TIN, then the transaction, if it is above 5 million, is what we are adding back, not the aggregate transactions. Yes. In the wear and tear schedule? Yes. Someone is asking, we said that in the wear and tear schedule, the roads vehicles, their value must be capped at 60 million. What if the value was less than 60 million? Then you have no problem. You take the value the way they gave it. Don't again take the 60 million that is the cap. When they say this is the cap, this is the maximum. So you only deal with those that go beyond 60 million. If it is less than 60 million, then you take the actual value. Ladies and gentlemen, you're going to have a break for only 10 minutes. So we come back here at midday. Have a break for 10 minutes. We will do 1 hour, then have a break, a lengthy break for 30 minutes for lunch. But now pick something that you can eat for the next 1 hour. And then you come and we look at something else. Guys, online, we are going to have a break for 10 minutes, and then afterwards you come back and run. Okay, so we can't waste any more time. We can't waste. We have only 1 hour for each of the other areas that are remaining. So each 1 hour is going to be a number. So tighten your belts properly. So we are now on employment income. Please call your neighbors to come in. Guys online, I don't know how you invite your neighbors to come in. We had about 200 online, and I am seeing now about 181. Where are the others? Please let your others know that we've started again. Okay, so we'll begin. You're going to have a number on employment income. Let me see if your past paper of last sitting has these numbers in both. Definitely. So when you look at, this is a typical employment income number. Let's settle in quickly. In the employment income number, I always find it as one of the easiest numbers. One of the easiest numbers. Because it only has one section like this of the law, section 19. Whereas the number that we have actually dealt with as number 1 is almost the whole of the Income Tax Act. Because if I told you all the things that we talked about, I would be navigating the whole Income Tax Act if I were to talk about the sections. But when it comes to income tax, rather to employment income, where we calculate pay as you earn, you're only dealing with one section, and that is section 19 of the Income Tax Act. And schedule 6, where we actually get the formulas for calculating benefits in kind. But what is the question going to be? For example, in this question of paper 11, in the last sitting, it was saying, advise JJ whether his incomes are taxable under the Income Tax Act, Cap 338, and determine his tax liability for the month of July 2025, if applicable. B, determine the JJ's rental tax liability for the year ending. Again, they are mixing the two. But for now, we are going to concentrate. Now, I want you to see part C. I told you I will keep cheating for you exams. Part C is saying, in accordance with the Income Tax Act Cap 338, explain the different benefits received by employees that are not included in the definition of chargeable income. Do you know what that question says? Is that saying, can you identify some of the employment income that is exempt? Yet when you're doing your number 1, there are incomes that you already said they are exempt. So you'll be picking the items you put in the computation and bring them here, because they're asking you, can you tell us some of the items that are not supposed to be included in the chargeable income? In other words, which are some of the benefits that are exempt. So someone who has done part 1 and has included some of the items that are exempt should be able to pass part 3. Part C. Part B is an independent number. Whenever you're doing any number, whether it is a separate number, whether it is part of employment income, whether it is part of business income, and you see anything to do with rental income, please, the principle is 1. That income must be taxed separately. Never mix it with any incomes, and never even mix the chargeable incomes. The chargeable income of rental must be taxed separately. Never aggregate it with any other income, whether it has a number of. Now, when you're dealing with a number of employment, there are two things. There is an employee and there is an employer. There is an employee and there is an employer. There are things that the employer is going to give you as an employee. Whether they are in cash, whether they are in kind, all of them are called employment income. Whether I give you this computer, it is considered employment income. Whether I give you any asset, whether I give you any benefit in kind, whether I give you a domestic assistant at home, whether I pay for your utilities, whether I give you a loan, we say there is a benefit in it, because the employer cannot give you anything that has no benefit in it. Now, whatever the employer has given you, the starting point is it is a benefit. Then the next question is it taxable or not taxable? They are paying for your transport back home. They are giving you clothes. They are paying for your membership to the ICPAU. They are giving you a motor vehicle. They are giving you a house. They are paying for rent for you. They are paying you medical insurance. They are paying you salary. They are giving you leave pay. They are giving you a bonus. They are giving you any allowance. As long as an item has come from the employer to the employee, we say there is an element of employment income. And the next question would be then, how do we get that employment income? And then is it taxable or not taxable? So you should not ignore any single item that they have described for you. Write it. And the next thing is you must be able to indicate whether it is taxable or not taxable. Because whether you say it is taxable, it is a mark. Whether you say it is not taxable, it is also a mark. And then the items you say that are taxable, you must put how much is the income that should be taxed. If you say, for example, someone was given a motor vehicle, and the motor vehicle, there is a motor vehicle benefit. The question is, what is the benefit in the motor vehicle? Because you just gave me a motor vehicle. Is it the cost of the vehicle? No. Therefore, there is a benefit that I must calculate, which is taxable. If the employer gave you a loan, the loan itself is not the benefit, but there is a benefit in the loan. If the employer gave you shares, the shares themselves are not a benefit, but there is a benefit within the shares that we must calculate. Now, if you're given a number on employment income, which you are going to be given anyway, you start with the heading. And the heading is this individual that you're dealing with. Now, before the heading, remember, employment income can either be on a monthly basis or on annual basis. When it is on a monthly basis, it is okay. They will be telling you how they are receiving things on a monthly basis. When they tell you it is on an annual basis, whatever was received on a monthly basis must be multiplied by what? If you're dealing with a number of 12 months and you're still taking the amounts of monthly and you have not multiplied by 12, you will fail it. So the starting point is ask, are they asking me for the annual or are they asking me for the month? How do you know they're asking you for the annual? They will say chargeable income and tax payable for the year ended. When it is a month, they will tell you for the month of this. And therefore you must know what to do. Because I've seen students who know how to do the employment number question, but they were asked for the year ended and they took the amounts on a monthly basis the way they were given to them. Because most of these amounts are paid on a monthly basis. So if you fail to multiply by 12, you get it wrong. Let's start. Now, again, I want you to draw 3 columns. Set your heading, Julius Nandeva's chargeable income and tax payable for the year ended 31st December 2024. For the month of November 2025, depending on what they have given you. But at the back of your mind, you know you're looking for pay as. At the back of your mind, you know you're looking for pay as earn. And the process of looking for pay as you earn is that you must be able to first of all look for chargeable income, and then using that chargeable income, go to the individual income tax rates that they have given you in your exam and calculate the tax for this person in form of pay as you earn. Now, all you need in a number of employment income, because the examiner is going to give you statements. They paid him a salary, gross salary of this. They provided him a motor vehicle. They provided him a house, or they were paying rent for him. They gave him travel allowances. He was given an air ticket. He was given this and that. That they have described, you must come and list it down here as your column number 1. Column number 2, you must make a decision now. Because the decision you make in column number 2 is what is going to determine what you're going to bring in here. The moment you say this item is taxable, because all these items that you see here are called employment incomes. All these items are called employment incomes in the description. But not all these employment incomes are actually taxable. Some are taxable and others are not taxable. And the examiner must see whether you know that something is taxable or not taxable. The moment you say that something is taxable, then the next question is, how much of it should we tax? What is the amount that should be included in the gross income? If you say that these are wages or salaries, how much are we talking about that we should include in the column of taxable? The moment you say something is exempt or is not taxable, we expect that the amount is going to be 0 because you're not going to tax any amount. Because at the end of the day, we want to aggregate only that is taxable and get our total employment, taxable employment income in this last column. Meaning, in that last column, we only have the amounts that are taxable, and the items that you say that are exempt have 0 in them. The moment you get this total taxable employment income, the only deduction that is allowed to an employee is called local service tax. Local service tax is what you're going to knock off on that income, and then you get the chargeable income. The moment you get that chargeable income, you're close to the end. The moment you get sorry, the guys online were not seeing this Excel sheet. So I'm saying you have 3 columns. You have the column for the description where you're putting all your items that I have given you. Don't miss any item. As long as the examiner has listed it in the question, also put it there. Whether you don't know the treatment or not is another question, but put it there. And then you should be able now to come and say, this item is taxable or not taxable. In column number 3, you should be able to indicate the items that you said are taxable. How much should we put as the amount? The items that you said are not taxable, you should put 0 as the taxable, the amount as the amount. And then you must aggregate the total that was taxable and call it your total employment income or total taxable employment income. From that total is where you knock off the local service tax in case it is there. Sometimes it is there, sometimes it's not there, but in case it is there, you knock it off from that amount. And then you'll be getting the chargeable employment income. When you go to the tables, you know the tables for individuals. Have you looked at those tables? Please don't get into that exam before you look at those tables. Because the moment you get the chargeable income, then you get out of here and go to those tables and see where that individual's chargeable income falls. And largely speaking, it will be in the last band. And then you pick the tax, and then you'll be bringing it here. Meaning the tax computation is going to be outside this as a working, and then bring your tax liability there. And you'll be done with the number on employment. All you have to cram now is what are the things that are taxable and which things are not taxable. So we'll go through most of these items. When you see them, now there are people who have cramming abilities that are at 90%. Cram them and hit them. At this point, we can't blame you for cramming them. I am not even asking you to understand them. Just cram them. When you see them, bring them. Because at this point, we are looking for passing, not so. So let's run through them. Now, I tell people that almost every item is taxable except these 8. So if you can cram the 8, then everything else that remains becomes taxable. So which ones are 8 that are not taxable? And I'm going to explain them. Let me confirm that there are actually indeed 8. There are 8 items. These 8 items, the moment you master them, you know these ones are not taxable. Anything else I see, I tax. Because the advantage is, whereas you might find the final answer, but every item you enter is a mark. So don't focus so much on the final answer, because the possibility of you getting every item correct might not be there. But every item you enter is what you actually look at. Okay, so let's first deal with the ones that are not taxable, and then we say everything else that remains is taxable, because the law is very clear. Number 1 is called cost of passage to and from Uganda. Now, when they are examining it, how do they examine it? The moment you see in a number of employments telling you that the person is an expatriate, the person is, they recruited him outside Uganda. When you recruit someone outside Uganda, you the employer, you have an obligation to bring him to Uganda together with his family. Relocate him. Sometimes they call them relocation costs. So you buy them their tickets, you buy them whatever they need to actually relocate from wherever they are to Uganda when they are coming for the first time. Mark my words, when they are coming for the first time, those costs of relocating them to Uganda are exempt from tax. You cannot tax it on the employee. Whereas you have met his costs to come to Uganda, you cannot tax it on the employee because they are called passage costs. Then that also relates to when their employment is done. Finally, when their employment is done and they are going back, the cost you incur to take them back is also not taxed on the employee. But what happens when this employee is already in Uganda and he has to travel back during the period to see his family, to go for a holiday, and it is the company incurring those costs? Then those ones are taxed on him. Have you got the difference? When he's coming for the first time and he's finally leaving when the employment is terminated, those costs that are incurred to relocate him to Uganda and back to his country are borne by the employer and are not, whereas they are not taken as benefits for purposes of determining the employment income of an employee. Are called passage costs. Sometimes they call them relocation costs. Number 2, reimbursement or discharge of employees' medical expense, including a premium or other amount paid for medical insurance. When, remember these 3 things, cram them. When it comes to medical expenses of the employee, we have 3 choices. You can actually tell the employee, we are going to give you a medical allowance as part of your pay. We are going to give you medical insurance. Or whenever you get sick with your family, go to the hospital, they treat you and bring the bill, and we discharge that bill. Now, among the 3, it is only one item that is taxable, and that is when you're given a medical allowance. Otherwise, when they put you on insurance, whether it is a benefit, but it is a non-taxable benefit. When you get sick and you get a medical bill and it is being discharged by the employer, whereas it is a benefit to you, it is not a taxable benefit. So when it comes to medical, only look out for medical allowance. That is what is taxable. Other than that, medical insurance or discharge of medical bills is not an allowance, rather is not a taxable benefit. Next, by the way, medical insurance includes also the group personal accident insurance. Next, now I want you to pay attention to this 3rd item. It's called life insurance premiums. It takes 2 angles. When the employer pays for your life insurance premiums, we ask the character of the employer. Is the employer an exempt entity for income tax purposes, or it pays income tax? When your employer is exempt from tax, we charge you as an employee on life insurance premiums. When the employer is not exempt, you are exempted from life insurance premiums. Now, how do you know that the examiner is testing this? The moment you're doing a number of employments and you see the examiner saying that the employer is tax exempt, they are actually giving you notes. They are telling you when it comes to life insurance, charge it on the employee. The moment they are silent and they talk about life insurance premiums, exempt it on the employee. I repeat it. It can fall under taxable or exempt. When does it become taxable? Generally, it is taxable. Generally, it is taxable. Sorry, generally, it is exempt. Unless the employer is exempt. Someone is looking at me. Generally, life insurance premiums are not going to be taxed on the employee unless the employer is exempt. So when the employer is exempt, and that is the first statement they will tell you, when they are giving you a number on employment, they will say the employer is exempt. The only item they will be testing is life insurance premiums, and now they are saying tax it on the employee. If they are silent about the character of the employer, then life insurance premiums are going to be exempt in the hands of the employee. People seem to be confused. I can tell it on the eyes. I want you to see this statement. Do you see this statement on 39, line 39? Life insurance premiums other than those paid by tax-exempt employers. Now, when it comes to, I want to see on the taxable items. The taxable items, there is life insurance. Where is it? I want to see the where you tax it now on the employee. They are telling you life insurance premiums paid by tax-exempt employer. So when the employer is tax-exempt, assume I am actually working for an NGO, and they have confirmed that this NGO is exempt from tax. The moment this NGO pays for my life insurance premiums, the law taxes it on me. Because for them, they are exempt. Once the employer is exempt, the employee gets taxed. Once the employer is not exempt, then the employee doesn't get taxed. So you either have it here when it is paid by a tax-exempt employer, or you have it here when it is being paid by a tax-paying employer. When the employer is tax-paying, it is exempt in the hands of the employee. When the employer is exempt, it is charged on the employee. I hope it is clear now. The next item on the list of exempt items are what we call subsistence allowances. Those are the per diems or allowances for accommodation, travel expenses, meals and refreshments while undertaking travel in performing employment activities. All of you guys in employment, sometimes you're required to go to the field. When you're required to go to the field and the employer has given you allowances to cover for your meals, for your transport, for your accommodation, whereas it is money coming into your pocket, it is not money that is taxable. Unless you receive accountable advances and then you fail to account for it. If they give you accountable advance, they have given you 2 million to go to the field, but the rule is go and spend and bring what you have not spent. If you go and spend 1.5 and you choose to retain the 500, we will tax you on the 500. Are you getting the difference? But other than that, most of the organizations have policies. They say every time you're going to the field, we'll give you accommodation 100,000, we'll give you meals 50,000, we'll give you transport say 50,000. So in total you'll be receiving 200,000, and you don't have to come back and account for it. That 200,000 becomes your subsistence allowance, becomes your per diem, and it is, whereas it is money that has come to you, it is money that is not taxable because you were facilitated while undertaking travel in the course of performing your employment activities. Next is meals or refreshments, all full-time employees on equal term basis. If they tell you that they provided the full-time staff with meals and refreshments, for example, in your canteen or in premises operated on behalf of your employer, and they are available, all staff on equal term basis, then we say you cannot tax it on any of the employees. The moment the equal term basis fails, it is the employee that suffers. The means that you've received will now be taxed on you as a benefit. For example, you find the MD eats food of 100,000, and then the lower cadre eats food of 10,000, then we are going to say you have failed the equal term basis, and we are going to tax the meals on the employees. Be careful. We are not talking about them giving you lunch allowance, because you can actually give a lunch allowance of 10,000 to every staff. It does not mean that you provided meals and refreshments. So whenever they give you money, we tax you. Hello? When they give you money in terms of liquid money, even if it is meant to cover your meals and it is on equal term basis, we still tax you, because the law only allows for meals and refreshments provided in your premises or in premises operated on behalf of the employer. If you fail on that, then they become taxable benefits. Then the other benefit that is exempt is benefits less than 10,000 a month. Sometimes you find employees are given some airtime allowance, but it's say, for example, 5,000. So any benefit that is given to you that is less than 10,000 a month becomes an exempt benefit. Now, do not aggregate, because it could be 5,000, but by the end of the year, probably it's more than 10,000. We look at on a monthly basis, is it less than 10,000? If it's less than 10,000, then we will not tax it. Next, number 7 is contribution or similar payment by the employer made to a retirement fund. We know we all have retirement funds, either NSSF or your provident funds. Some of you have funds called provident funds, or any retirement benefit. That additional contribution that is made by the employer, it is for your benefit, but it is not taxable on you. We would agree that the employer, for example, contributes 10% over and above your gross pay. Not so. That additional 10%, it is a benefit to you, but it is not a taxable benefit. And finally, we look at the value of a right option to acquire shares granted to an employee under an employee share acquisition scheme. Now we have 3 things under the share acquisition, employee share acquisition scheme. 2 of them are taxable, 1 of them is not taxable. That's why I told you, when you get a chance to hit more than one bird with one stone, you remember it. When it comes to employee share acquisition scheme, we have 3 items, and 2 of them are taxable and 1 of them is not taxable. In simple terms, by the way, share acquisition scheme is where you have allowed employees to actually buy shares into the company, especially the long-term serving employees, the strategic employees. You give them targets and say, once you hit these targets, we'll allow you to be part of the shareholders. Those are the share acquisition scheme. So how do they operate under Section 19? We have three things that you must remember. One is where the employer has given you shares and has given you shares at a value less than the market price of those shares. Assume the shares in the company are at 200 shillings per share, but they give you a benefit as an employee and say, you are going to get shares from this company and you're going to be paying 150 shillings for each of the shares whose market price was 200. It means the benefit is what? That difference, the 50, not so. So whenever you're given shares, but they have given you a price lower than the market price, we are looking at the benefit in the price. The price was at 200, but they gave you at 150. So you get the difference and multiply by the number of shares they have given you, that becomes the benefit. That's when they have given you actual shares. Now, when they don't give you actual shares, they give you a promise to acquire shares. That promise is called a right or an option. It's called a right or an option. Now, as you advance, I know some of you have done your advanced FR, you see things called financial instruments, IFRS 9. When you look at financial instruments, when they give you a right, when they give you an option, it becomes a financial instrument, and therefore it has a value attached to it. It is even an employee benefit. If you look at your IS 19, employee benefits, it actually speaks into the benefits that you, but there's nothing tangible yet they have given you. They have only promised that when you actually hit a certain target, we allow you to acquire shares. Now in employment, we say, when they have given you that right or option, it is not yet a taxable benefit. But when you go ahead and transfer that right or option to someone else for a gain, we tax you on the gain. I will repeat it. We have three things. They have given you actual shares, but at a reduced price. That is automatically a taxable benefit on the reduced price. Number two, they have given you share option or it's either called a share option or right. If you have not disposed of that share option or right, it is not a benefit, it is not a taxable benefit in your hands. So the share option or right itself is not a taxable benefit. But the moment you go ahead and dispose of that share option or right someone else for a gain, then we tax you on the gain. Those are the three things I'm talking about. So one of them is here. The value of a right or option to acquire shares granted to an employee under an employee share acquisition scheme. That is exempt. Which ones are the two that are taxable? One of them is here. The value of shares exceeding consideration paid by an employee in the share acquisition scheme. They have given you shares, but you have paid less than the actual consideration. The other one that is taxable, gained by an employee on disposal of a right or option to acquire shares in a share acquisition scheme. Here, when they gave it to you, we did not tax you because it is not yet of value. If you go ahead and dispose it off, we tax you on the gain. If they give you actual shares, we tax you on the reduced consideration. Those are the 3 points that I was talking about. Now, these are the 8 items that are not taxable. You remember them? The moment you remember them, then we know that we now can turn our guns to the taxable items. So which are the common taxable items that you're going to see? Number 1, wages. Number 2, salary. Number 3, leave pay. Number 4, payment in lieu of leave. Number 5, overtime pay. Number next, sometimes they don't call it wages, sometimes they call it fees. That they have given you fees. I'm not talking about school fees. I'm talking about if they value work in terms of fees or commissions. Number next, commissions. If they give you any commission, some of the marketeers, they say will give you a basic salary and also give you a commission on honest NSLs that you make over and above the minimum. So that commission is also taxed. Gratuity is taxed. Ladies and gentlemen, gratuity is different from pension. Again, that's where the confusion of students come from. Gratuity is different from pension is exempt. Gratuity is taxable. Remember that. So among the things, if you see any pension, it is exempt, but gratuity is taxable. Next is bonus. I heard you guys quite about the URA bonus. It is taxable and we are also taxed. Some people are saying, you know, can you imagine they even receive these bonuses and they're not taxed? The private companies pay bonuses and they are even taxed. We are also taxed. So the bonuses are also taxable. Travel allowance not paying per diem. If you did your private travels and it is the employer paying your travels, and it normally happens with the MDs or expatriates. I have come to Uganda to work, but whenever I am going back to see my family, they buy me my tickets, they sponsor me for holidays. Those are taxable on you because they are now private travels. Next is entertainment allowance. You know, sometimes when we are talking about some of these allowances, when you're not yet an MD, you can't know. MDs are paid entertainment. You know why? Because they know in the evening they will sit at Serena to also relate with other MDs, and the cost of that is part of the expenditure. So they pay them some entertainment allowance, and it is taxable. Allowances for utilities. Sometimes they give you some allowances to cover your utilities. Allowances covering cost of living. They have given you additional allowances to actually cover more costs. Now, I want you to understand this thing called housing allowance and housing benefit. Do you know the difference? There is housing allowance and there is housing benefit. One requires a formula, another one does not require a formula. So you must know, when do I have to use a formula? When don't I have to when don't I have to use the formula? When they tell you that they have given you a housing allowance or they have given you accommodation allowance, that is taxable automatically without going through any formula. But when they tell you that they have given you a house or they are paying rent for you, you must go through a formula. And we are going to see the formula for calculating housing benefit. You only think about the formula if what they are giving you is not money. It means they are either giving you a house or they are paying rent for you. But when you actually tax the money, we tax the money directly. There is no complication. The complication comes when they are giving you a house. We said medical allowance is taxed. Any other allowances that they give you, ladies and gentlemen, by whatever name, any other allowances they give you, as long as they are not part of the other 8 items, they become taxable. Why? Because the law cannot describe every nomenclature. I have seen students, I've seen some companies paying what we call cash handling allowance. Do you guys receive cash handling allowance? Sometimes when you're the cashier, because they know you do some losses, the tellers in the bank, I am told they are given some cash handling allowance because they expect you like it to make some shorting. That cash handling allowance is also taxed. In other words, put it at the back of your mind that whenever you see an allowance, because an allowance means they have given you money and it is not excluded among the 8 items, then automatically it becomes taxable. Now, after that, we then look at what we call the benefits in kind. These items are called benefits in kind. Where they stop here. Let me put them somewhere. Okay, up here. I can put them in green. Now, There are things that they will give you which are not in monetary terms per se, but they have given them to you anyway. Or they are paying them on your behalf. And when they do, we ask ourselves, what is the benefit in them? The basic formula is that whatever the employer has paid for, if you did not contribute to it, automatically what the employer has paid is what is your benefit. If they are paying for your electricity at home, if the bill is 100 and the employer has paid all the 100, the whole 100 becomes a benefit. But if the bill is 100 and for you contribute 20, the only benefit is 80. So use some common sense. The bill is 100,000. The employer has only paid 80 and I'm contributing 20. So which one is the benefit from the employer? It is only 80. So every benefit that they give you, if the examiner tells you that you contributed some money to that benefit, that you contributed is knocked off from the total. I hope you get that basic principle. Okay, so let's look at the common benefits. And I will warn you some of the formulas that you cannot afford to get into the exam without understanding. And number one is motor vehicle benefit. Motor vehicle benefit. When do you tell that there is a benefit arising out of motor vehicle? They will tell you that the employee was given a motor vehicle. If the examiner has not strictly said, and you mark my words, if the examiner has not strictly said that this motor vehicle is strictly for official use, it means you must go ahead and calculate motor vehicle benefit. How do you calculate motor vehicle benefit? The formula is here. And I have seen so many confusions about this formula. I want to iron out any confusion that is in the motor vehicle benefit. Ladies and gentlemen, the formula is 20 past, by the way, open brackets. Those brackets are very, very important. You miss the bracket, you will actually be calculating something different. So the formula is, if I can expand it here so that you're able to see it, the formula is 20% into brackets. So if you open the brackets, 20% times A times B over C, close the brackets, minus D, meaning D is outside the brackets. Now I'm going to talk about each of the items quickly. D is what the employee has contributed, if he has contributed anything for the benefit. Any benefit that, rather any contribution that has been made, any payment that has been made by the employee to get that motor vehicle benefit is your D. So if the employee has not contributed anything, or if they are quiet about the employee's contribution, D is 0. 20% is a constant. It is not a rate of depreciation, it is not a rate of anything. It is a constant in the formula. So 20% cannot change, and it does not represent anything like depreciation. Because the confusion with students is when they get into that formula and it requires depreciation, they're asking whether the 20% is the depreciation or not, or whether we are applying 20% or 35%. So I have first talked about the 20%. It is a constant. So you get 20% times A. Now that is where I want to emphasize, because A is where people mess it up. If I have been given a motor vehicle and I am an employee and I have been given this motor vehicle in January of 2025, assume they recruited me in January 2025 and immediately they gave me a motor vehicle which they had picked from the bond or they had bought at 500 million. The value of that motor vehicle is 500 million. Because at that point we are looking for the carrying value of that vehicle at the point when the year is beginning or when it is first placed in my hands. So the value on 1st of January when it is first provided to me is 500 million. If I cross 2026, that value will no longer be 500 million because the vehicle has now moved for one. So in January 2026, that A will no longer be 500 million because I will say I have already used this vehicle for one. So my A will now be the carrying amount of the 500, meaning you depreciate the 500 million by 1 year. And the depreciation rate is 35%. And the reason why I'm emphasizing 35%, because when people see a motor vehicle, they want to relate it to what they saw in the wear and tear schedule. Section 27 is different from Section 19, and they have no relationship. The Section 27 describes a motor vehicle to be in the third schedule for purposes of calculating wear and tear allowance. Section 19 talks about depreciating this vehicle using 35%, and they have no relationship. Whatever is described in the law, you cannot say, but this vehicle, when we take it to, yes, you took it to the wear and tear for purposes of calculating business income. You're now calculating employment. Do you get the difference? So A, if you want to cram it in the easiest way, A is the net book value of that motor vehicle. But that net book value must be calculated at the beginning of the year and not the end of the year. Meaning, if I got that vehicle in January 2025 and it was at 500, in January A, it would be 500. But in January of the next year, it will be 500 reduced by depreciation. In January of the next year, it will be 500, rather it will be that net book value because it is on reducing balance basis. Reducing balance basis means depreciation is calculated on net book value and not on the cost. Okay, that is our B, our A. Our B is asking a question, and our B is only going to be relevant if the examiner tells you that some days that vehicle is not available to the employee. If the examiner is specific. If the examiner is silent, but he tells you that this vehicle was given to the employee and is silent about when it is not available, you assume that B is 365 days and C is also 365 days. When did you reduce the B? Is when the examiner has told you that, for example, this vehicle is not available, say, on weekends. This vehicle was not available in the month of December, or in the month of December, this employee goes on leave, and when he's on leave, the vehicle is parked in the premises of the company. But when he's silent, you take B and C to be the same, 365 days. I hope we are clear. Okay, so the formula is 20% times A times B over C, close the brackets, minus D. If you miss any bracket, you're finished. And do not get into the exam without applying that formula and you see that you have got it right. If they ask you a question and it is on a monthly basis, you first apply the formula as is, and then later, after getting the result, is when you divide by 12. Because that formula is premised on annual benefit. So you first calculate it as is, and then after getting the answer is when you divide by 12. So that was the motor vehicle benefit. Next benefit, the other benefits are easy. Maybe the housing benefit is what I'm going to emphasize on. The other benefits are, for example, they have given you a housekeeper. They have given you a chauffeur. A chauffeur is a driver. Now I want to ask you, if they gave me a motor vehicle, they have given me a driver, they have given me a fuel card or fuel, I have 3 benefits. I have 3 because there is a motor vehicle benefit, there is a driver benefit, and there's also fuel benefit. Now, chauffeur, I told you the chauffeur is a driver, gardener or any other domestic assistant, whether you want to call them shamba boys, whether you want to call them housemaids, whether you want to call them aunties, whatever you call them at home, if the employer is the one paying them, what they are paying them on your behalf becomes your benefit. If you're contributing to that payment, we knock off the payment that you have made. Guys, if you've taken a lot of breakfasts, I recommend that you stand behind but listen in, because we are in the middle of the exam. Dozing at this time is like committing suicide. It's like committing suicide. Because whatever I am actually doing, I am reducing down a 360 textbook into one day. So you must listen in to whatever I have said. If you listen in as a song and you doze, you're finished. Because you go back and read the 365 pages. Just stand up, no one is going to blame you. You can even stand behind me, but listen. Because I get worried at this point. You can't afford it. You can't afford not to listen. You can't afford it not to. This pro bono class is meant to restore you from. This pro bono class is just to restore those who have not prepared themselves. Because I want to make sure that I am. They say you cannot fatten a goat on the market day, but I'm now fattening the goat. I'm now fattening the goat, and the goat must give us results. Okay, let's quickly do. Now, there is one domestic assistant that you must be aware of who is not taxable, and that is called a security guard. Guys, security guard is different from when they give you allowances for security. It is different from when they press cameras, security cameras in your home. A guard is a guard, and a guard, looking at the practice note of 2001, they have specifically said a security guard is not a benefit. Just like I'm going to also notify you on housing. When it comes housing, you allow me, you also remind me to talk about boys' quarters. So among the domestic assistants, all others are taxable on you if the employer is the one paying for them. If you're making any contribution, you knock off that contribution. If for example, the driver is paid 1.2, but you contribute 200, so you're going to get, if it's annual, you get 1.2 times 12 months minus the 200 that you contribute per month times 12. Not so. So any contribution made by the employee is knocked off from the payment made by the employer. The next benefit is provision of any meal, refreshment, or entertainment, not on equal term basis. Because we said when they give you meals and they are on equal term basis, you survive taxation. But when we actually don't get the equal term basis, you saw the case I shared with you on Security Farm, where they found that the meals were not provided on equal term basis, and they had to tax the employees. Definitely, if the employees are not there, it's the employer that has the obligation. Remember, pay as you earn is a form of withholding tax, meaning if the employer fails to withhold, the burden falls on him first, and then he can choose to transfer the burden to the employees if they are still there. Provision of utilities in respect of the employee's place of residence, utilities such as they are paying for your water, they are paying for your waste collection, they are paying for your electricity, etc., etc. Now, I want to emphasize on the loan benefit, because it's another computation that you must remember. And the computation is right here. Loan benefit, where are you? I'm here. Condition number 1, the loan must be above 1 million. The loan must be above what? 1 million. Condition number 2, the interest rate the employer has given you must be lower than the statutory interest rate. And statutory rate is the same as BOU rate. And the rate that we are talking about is the rate at the beginning of the year and not at the end of the year. Have you seen questions where they give you two rates? At the beginning and the end? The rate you apply is the rate at the commencement of the year and not at the end. So how do you then get the benefit? The benefit generally is the difference in the interest. The employer gave you either an interest-free loan, that means 0, or gave you 1%, 2%, 3%, whereas the statutory rate is 10%. So the benefit is, what was the statutory rate? 10%. What has the employer given me? 0%. 10 minus 0. What is the benefit? 10% times the loan amount. That becomes the loan benefit. The employer gave you 5%, statutory rate 10%. 10 minus 5%, that is 5% as the benefit. Multiply it with the loan amount, you have the benefit. Again, if you're dealing with a monthly basis, you multiply by, rather you divide by 12, because when you talk about rates, these represent annual rates. Okay. The next benefit is called waiver by an employer of an obligation of an employee to pay or repay employer's debt. This happened so much in COVID. From the cases we have tested, some of the employees that had loans from the employers said, now we know you're stuck, we are forgiving you these loans. The moment they say they have forgiven you those loans, for us we see it as a taxable benefit, and then we pick the tax in the amount that you should have paid, which the employer has waived. Waiver by an employer, transfer or use of property or provision of services to the employee. When the employer gives you a computer for taking, please don't confuse them. When you go to work, they give you equipment, they give you tools. Those are not your tools. What we are talking about is when they have given you those equipment to take. There is a motor vehicle, probably for them, they think the company no longer needs it and they have given it to you. They have said the second-hand computers, they have given them to you. The moment they give you any property, then we look at the value in the property, and that is the benefit you have received. If you have contributed anything, if you have made any payment, we know of what you have paid. Now, we come to this item called provision of accommodation or housing. And I said that one will come when you have been given a house or you have been paid rent for. That's called the housing or accommodation benefit. Principle number 1, that housing or accommodation benefit must be calculated last. That accommodation or housing benefit must be calculated last. By the only way you can avoid sleeping is take notes. I don't know whether you have a very big head that whatever I've said, you've actually going to remember it. Because there are people that have kept on looking and they are looking at me and I'm speaking. Are you sure whatever I've said you have picked? Are you sure? Those who are not writing, are you sure whatever I've said you picked? This paper is on when? On Thursday. What time? Afternoon. It is what season? I don't know. You must go with water, otherwise they will see blood sweat getting out. Because the sweat will get out and then they start seeing blood coming out. But you don't know where the coldness comes from on that day. Even the ones that had no flu start sneezing. So, to avoid that, guys, those who have tested these papers, when I'm teaching them, someone says, but these things are so easy. You get it and these things cannot come through your head because you didn't write them. So please write them. Okay, so I said, when it comes to accommodation, you do it last. Because it uses this item in the computation of housing, you use this last item that we called total employment income. This item that we call total employment income here. In the computation of housing, you use that total employment income. But you're using it prematurely because the housing benefit is not yet there. So you first pick this item after you have put in everything that you thought is taxable. You first get the total but have it on the side because you would use it in the formula for housing benefit. But when you see housing benefit, make sure that among the items you list, also put there an item called housing benefit. Then wait for it to calculate it. Because when you don't put it, you might actually forget it because of the pressure. So as you see an item of housing benefit, put it in your answer, but wait to calculate it until you have calculated all the other benefits. Now, how do you calculate the housing benefit? This is the formula again. Okay. So warning number one, I'm saying housing or accommodation, this must be calculated last. So how do we calculate it? We compare two things. And when we compare the two, we pick the lesser of the two. So you calculate A, calculate B, compare the results of A and B, get the lesser of the two. What is the lesser of the two is what you take in your tax computation as a benefit, housing benefit. So what is A, what is B? What is in A is the market rent of the accommodation or housing reduced by any payment made by the employee for the benefit. Let me make it easy. They told you they gave you a house. Once they gave you a house, the examiner will tell you the annual market rent of that house. If they are paying rent for you, you know how much they pay on a monthly basis, multiply by 12. If they are paying 1 million, it means the annual market rent is 12 million. If the employer is giving you a house, the examiner will tell you the annual market rent. That annual market rent can only be reduced by what the employee is contributing. If the employee is contributing nothing, it means you only take the annual market rent. I hope A is the easiest because you don't even need to wait. You can actually do a working, but work on it partially. Do the A and wait for the B. Because the A, you can do it without first finishing the number. Because A says, get the annual market rent minus the employee's contribution. And I said, if they have given you a house, the examiner will give you the annual market rent. If the employer is contributing anything, knock it off. If they are paying rent for you, you get the rent that they pay on a monthly basis times 12. That becomes the annual market rent. And then remove what the employee is contributing. That becomes your A. Then B. B has two ingredients. It has this number, this final number called total taxable rental, rather total taxable employment income. So you first get that number that you had before putting in any housing benefit, because you don't have the housing benefit yet, but you have all the other benefits, you have all the other taxable incomes. So that's total. Bring it here in B. Because B says, this is what B says. It says 15% times, I am opening the brackets now, times the employment income. The employment income is what you have in your calculation now, plus the amount calculated in A. So what you calculated in A plus the other employment income gives you the total, and that total you apply 15% on that total. So if I am looking at B, I'll first add the total employment income that I already have, assuming that I have already considered all the other benefits. The only one that I have not considered is housing. So all the total employment income that is taxable, I have aggregated it. I now add the figure that I already calculated in A. That total, I multiply by 15%. I'll be getting my B. After getting my A and B, I compare the two. And whatever I get as the lesser of the two is what becomes my housing benefit, which then I take to my computation. Meaning, this figure, the moment you see that the employee has been given housing, don't rush putting this figure there, the total, because it will be used in calculating housing benefit. So you first put it on the side because you have to apply it in the housing benefit computation, and after getting the housing benefit, you bring it in your computation and then re-add your employment income. That is housing benefit. The other item that is left, provision of any other benefit not being exempt. Then from the other taxable benefits, we have discharge or reimbursement of employee private expenses. Whenever it is the employer paying your private expenses, and this is excluding medical expenses, because you say the employer can pay your medical expenses and it is not taxable on him. But any other expenses that belong to you, and it is the employer that has discharged them, what the employer has paid on your behalf becomes a benefit to you. Now, I want you to pay attention to this next one. Terminal benefits or termination benefits. Please remember this principle. Terminal benefits are taxable, but there is a benefit in a benefit. If you have been working for the same employer for 10 years or more, when they finally pay you termination benefits, we are only going to tax you on only 75%, and the 25% will be exempt. In other words, if they paid you terminal benefits of 100 million and you have been working for this same employer for 10 years or more, what we are going to include in taxable income is only 75 million, and the 25 million is going to be under exempt. But if you have not been working for the same employer, or you have not made 10 years, then all of the 100 will be taxable benefit. In simple terms, terminal benefits are all taxable except when you have worked for the same employer for 10 years or more, and that's when we tax only 75%. I had already explained life insurance premiums paid by a tax-exempt employer. I want to repeat that. Then there is one we call payment as consideration. Payment as consideration. Payment as consideration. So payment or consideration for the employee's agreement to any conditions or change in conditions of employment. They will call it different names. Have you had names like hardship allowance? Have you had names like hard to reach allowance? Have you had names like, what else do you call them? Eh? It's called what? So if you, for example, sent very far from Kampala City to work there, and because the place they have sent you to work in is very hard to reach, it's very hard, it has no internet, it has no schools, it has no nothing, but they pay you some money to compensate for that. Disturbance, actually sometimes they call it disturbance allowance. Hardship allowance, disturbance allowance becomes part of the taxable amounts. I had talked about shares, I had talked about gain on share acquisition schemes. Now, the last thing I want to teach you about employment income, and let me see, I already talked about the provision of a guard is not a taxable benefit, and also the provision of boys' quarters. Even if they give the boys' quarters market values, please don't be tempted. Boys' quarters, the law says they don't have a separate market value. So even if the examiner tests you and wants to see whether you actually have that knowledge, please never calculate housing benefit on boys' quarters. Still indicate to the examiner that these are not taxable. Now, finally, I want us to test ourselves whether we have mastered the use of these tables. Please, I want everyone to do for me a computation quickly as you cross employment income. because that's the last test I want you to do. And everyone must comfort themselves that they know what to do. Don't assume from your neighbor. So, I want to see everyone applying this. I want to see how everyone applies this formula. I can guarantee that the number that you're going to get, if it is on an annual basis, it is going to be an amount exceeding 4,920,000. What is that on a monthly basis? Now, I want you to look. Do you have the tables? Do you have the tax computations? Do you have the income tax rates? Please check. When you see the income tax rates, there are amounts that are in brackets and the amounts that are outside the brackets. When you're doing the number on a monthly basis, you use the amounts in brackets. If you're doing a number on annual basis, you use the amounts outside brackets. What do I mean? If these amounts, these rates are on an annual basis, if I am going to give you this table, the 4,920,000 would be 410 per month. The 300,000 would be how much? 25,000 per month. The 120 million would be how much? 10 million. So always see those amounts. Sometimes when students see them in brackets, they don't know what, and they will say PM. PM means per month. But I'm now going to assume they're going to do a number on an annual basis. Now I'm going to give you two numbers, and you give me the tax for this person. Assume you have done so well, and you have your chargeable income, and it's correct. You now reached a point where you're going to charge the tax. And I'm going to give you two numbers. One of the numbers is that your chargeable income from your table has added to 90 million. Has added to 90 million. The second option, your table has added to 150 million. So for those two numbers, give me the tax payable by the employee. One employee is earning total employment income, total chargeable income of 90 million. Another one you discovered has chargeable income of how much? 150 million. Give me the tax that they should be paying. And if you get different numbers from your friends, you know you have not mastered that table. That is a simple test. Once you're done with that table, with that test, we'll get out of that number and get for lunch. We are only going to use the remaining time after 2. So the longer you take to finish you're already in your lunchtime. I have already declared your lunchtime. Lunchtime is from now up to 2. I should also calculate it here so that you don't lie to me. Guys online, put your answers on the chat. Who was the answer for number 1? Where the chargeable income is 90 million? Huh? So if you don't have 25,824, you're wrong. The answer in number 1 is 25,824,000. you don't have it, you go and do homework again. We are using the resident rates. If you're using the non-resident rates, you get it wrong. And by the way, anyone who comes here and works for more than 6 months, he has become a resident. If you're doing a number on 1 month and it's an expatriate, in that 1 month, if it is his first month, he's still a non-resident, irrespective of how long the contract will be. You might sign a contract of 3 years, but in the first 6 months, you'll be a non-resident until you cross the 283 days. And the 283 days simply means 6 months and 1 day, not so. So, if you're doing a number on annual, then automatically that individual is a resident. That's why I'm emphasizing you looking at the resident rates. Number 2, what did you get? 46,824, not so? Is the right amount. If you didn't get it right, you still have to do your homework. I declare a lunch break until 2 p.m. So come back at 2 p.m. and after 2 p.m., at 2 p.m. we'll start looking at the next number, and that will be VAT.
Guys, I have some questions on donations. Which chargeable income do we take? Do we take the one after deducting the losses brought forward?
Pardon?
We use the adjusted taxable income.
So it's after deducting the loss brought forward.